New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures ticking slightly lower this morning. We're tracking a weak read on the housing market with new construction falling in July. But the major averages all on track for a winning week. Smile! Let's get to it. The three things you need to know to start your trading day. Yahoo Finance's Jared Blickried, Josh Schaefer, and Ben Workshall have more.
Stock futures slightly in the red this morning. The S&P 500 and the NASDAQ fighting for 7 straight days of gains, both on track for the best week of the year. The gains fueled by renewed confidence in the consumer and the economy. Retail sales data in July came in much stronger than economists expected, and weekly jobless claims, they fell, soothing some fears of a slowdown in the economy and the labor market. Those fears, coupled with an unwinding of the yen carry trade, they sparked a global sell-off earlier this month.
Since that market sell-off on August 5th, the S&P 500 is now up almost 7%, and the NASDAQ composite is up more than 8%. And a look under the hood shows that once again, big tech is leading the charge higher. The information technology sector, or XLK, is up almost 12%. NVIDIA, the leader of the AI craze, is up more than 21%. Many strategists told Yahoo Finance after the sell-off they expected tech stocks to come roaring back.
And Vice President Kamala Harris will begin to sketch out her economic vision this afternoon in a speech in Raleigh, North Carolina. It includes several efforts on inflation that she says she'll undertake in her first 100 days in office. She'll call for the construction of 3 million new housing units in 4 years, largely through tax breaks for both home builders, homeowners, and landlords. She's also releasing a plan on a federal ban on food price gouging as part of a larger effort there against the practice. And finally, she'll announce new efforts around healthcare costs, including a push to cap the price of insulin at $35 for everyone, not just for seniors.
Let's get you set up for the trading day with the market action here. Stock futures in the red this morning, as you're seeing here. The major averages still on track, though, for the best week of the entire year, all of 2024, with the S&P 500 rallying 7% this week, while the NASDAQ 100 is up more than 5%, the biggest gains for both indexes since November.
And let's take a look at the bond market. We've seen quite a bit of action there as of late. You're looking at yields dropping across the board here this morning. You got the 10-year off just around 5 basis points below that 3.9 level. Now the move lower this morning, retracing some of that surge that we saw in the wake of positive econ data out earlier this week. So again, when you take a look at the bond market moves, couple that with some of that excitement that we've been seeing within the stock market there, really shows, I think, Brad, just what investors are pricing in at this point. A little bit more optimistic that maybe we are going to be able to avoid a recession. Then also just where they're seeing some of that opportunity is so interesting too, especially in some of those beaten down tech names.
And it's interesting as well because you kind of juxtapose that, or at least combine it with what we're hearing from Fed speakers over the course of this week. Even today, you've got Austin Goolsbee, who's out saying that there are some recession triggers and warning signs that are flashing. But for the markets, at least, that might be digested as, hey, that just means that we're finally going to get these rate cuts, right, that we've been talking about throughout the entire year. So we'll see what that setup looks like going into September and where more of that Fed speak continues to move the market dialogue.
The market always finding reason, at least to be optimistic, it seems like, as of late. All right, let's talk about some of those gains in big tech, because once again, you're looking at the handful of tech names leading the market's most recent rally. You've got the NASDAQ up more than 8% since that sell-off that we saw at the beginning of the month on August 5th. Let's bring in our markets reporter, Josh Schaefer, who has been closely tracking this. And Josh, we are certainly seeing a lot of investors digging in and buying some of those names that have been beaten down.
Yeah, Shauna, you did see some dip buying specifically in the tech sector and really in the indexes overall. So I want to start with the indexes because I think there's some intuitiveness to take out of this of what people were saying when we had that sell-off on August 5th. So your indexes there are in yellow and orange. The S&P and NASDAQ are now positive since that sell-off on August 5th. And you think back to what a lot of strategists we had on air that day were saying is understand why the market is falling today and does that change your thesis? And I think for a lot of investors, it didn't actually change their thesis. As we've talked about over the last week, a lot of the fall in the market had to do with the unwinding of a yen carry trade, which I think most investors probably don't even understand what that means on its surface. They probably don't even need to understand what it means on its surface, right?
I talk about it at the barbecue all the time,
right?
Josh.
Yeah, right. We're talking about how we want to use leverage to buy all these things, right? But if you're not using leverage then maybe it just doesn't matter to you, and maybe you shouldn't be worried. And if what's happening isn't a thesis changer, then maybe just stay in the market. And that's played out for investors that stayed in the market. On the tech side, we had a large tech sell-off leading into the bigger market sell-off. And then what happened was you saw at that point the NASDAQ enters correction territory, down 10%. And all of a sudden everyone says the risk reward looks a little bit better now. After this big sell-off, maybe it's a time to get back into tech stocks. And Shauna, I know that's something you had been talking to strategists about and saying, maybe it's time to be a dip buyer at the start of last week.
Yeah, and what I think is so interesting, and we'll ask Drew Pettit over at Citi this question later on this morning, but now I wonder how they're viewing the current valuations, because yes, they're still more attractive than maybe they had been just in terms of if you compare it to where they had been earlier this year, but still though, after this massive climb, is there now a reason to sell, or are they finding reason to hold on to these names because the narrative has sort of shifted in the market just in terms of what we could be expecting with the Fed and rate cuts and how exactly that's all going to play out? So I think that's going to be so interesting, too, to see how people are feeling here today.
The easy buying is definitely over, right? So Keith Lerner over at Truist, who had upgraded the tech sector last week, he did some great work highlighting the the tech sector's outperformance in the S&P 500 in June. On a rolling 2-month basis, it was the best the tech sector had ever done versus the S&P 500 since 2002. Then you spin that forward to the sell-off, it was the worst the tech sector had done against the S&P 500 since 2002. So you had this big dichotomy there, and then so it's easy to come in to some extent, easier, at least a bit more obvious, I guess I should say, to come in and say, okay, now tech looks a little bit oversold, but now we're past those levels. And now the question is, okay, what did we actually hear from those earnings?
Yeah.
And do we feel confident in the earnings growth trajectory moving forward?
Yeah, and I also think going off that, just what exactly is going to be that catalyst for future growth and what that future growth looks like.
NVIDIA earnings. We still have NVIDIA earnings,
like
guys.
So much, yes, exactly. So much is riding on NVIDIA earnings. What happens if they disappoint? What happens if they just come in line with expectations? Because we've seen the fact that obviously the market has not been satisfied with that in the past.
We said last quarter, NVIDIA earnings were the biggest deal ever, right? We wrote about it and talked about it for a week, and then the market didn't do anything.
Yeah.
The market actually went down, I think, in the couple days.
So then what does that tell us?
NVIDIA.
That doesn't sound too good then maybe for some of these tech stocks.
Yeah, I think the broader question will continue to be, you're going to hear this 493 versus Mag 7 conversation continue to really lead what people are talking about. And the question being there, okay, if I'm looking to outperform the index in the final months of the year, is tech the smart place to be? Because is there enough future gains within that, or is this rotation going to be where I can outperform the S&P 500 to end 2024, right? That's what a lot of these strategists are really talking about here, is to get a little bit of alpha.
Listen, all right, Josh, great job breaking all this down. Thanks so much. Let's take a look at the econ side of things, because we got a slew of data out this week countering some of those worries of a hard landing and easing the recession anxieties. The next read is University of Michigan's Consumer Sentiment Index. That's out later this morning. It's going to give investors a little bit more insight on the state of the consumer. Here to unpack what this all means for the broader economy, we want to bring in Tiffany Wilding, PIMCO's managing director and economist. Tiffany, it's great to see you here this morning. So let's talk about some of the data that we got out this week. We had jobless claims easing some of the fears that we're starting to see the labor market fall apart. You once again had strong retail sales, or stronger than expected retail sales. What does that tell us about the odds of a recession? Has that essentially been taken off the table for now?
Well, so I think the concern was that we were in a recession right now. So when all of these sort of recessionary fears started, it was because the so-called SOM rule, which is looking at the unemployment rate from the labor market report, has triggered that. So in the past, when you've seen the unemployment rate increase a certain extent beyond a, quote, trigger, historical trigger, it has suggested pretty universally that the economy is in recession right now. However, if we look at the underlying drivers of the recent unemployment rate rise, they're actually quite different than they have been historically. And you always want to be careful of this time as different comments, but we've had extremely good labor supply gains over the last few years. And obviously that's been helped by the immigration surge that we've had. And when you have labor supply gains that's driving the unemployment rate, instead of actual levels of employment, labor shedding, job losses, then that suggests the economy is slowing for sure. Labor markets are becoming in better balance, but we're not in a recession right now. And I think that's what was the fear last week. And of course, this week's data, including the retail sales data, just completely dispelled those fears.
I mean, you have Goolsby out saying that we are seeing some flashing signals of recession. So, Of course, the Fed is going to be walking a tightrope here of trying to make sure that they're able to pull off a soft landing that which many economists had told us that was already done. And so at this juncture, if you still see some of those potential signs of recession, where does that put you in the camp for the type of cut and the pathway of cuts that we should expect from the Fed?
Well, I think when we look at the balance of risks to the outlook, what we see has changed more dramatically recently is the balance of risks around inflation. The inflation data has given us and should give the Fed, much more confidence that we are seeing progress again. Shelter inflation in the United States, which had been elevated, it tends to be, very connected to the labor market, domestic, labor market pressures. That piece of the inflation basket, that started to moderate again, kind of recently. That's important. Also, the context that you see job openings, vacancies to the unemployed, those levels have gone back to pre-pandemic levels. So I think we have seen a change in the distribution of risks around inflation, and I think that's important. And so what does that mean? Well, it means that, of course, the Fed is now going to be, much more focused on any sort of weakness in the economy. And we do think growth is slowing. Growth was with 3% last year, very strong pace, above trend pace. We think it's slowing, and that's kind of healthy this year. But so it doesn't necessarily mean that we're going to slip into a recession. I think there's still, very firm pieces of the economy, solid pieces of the economy, including consumers overall. But of course, the Fed will have to be vigilant to that. And because of this distribution of risks changing on inflation, it does mean they can start to reduce policy. Much less need for restrictive policy in that environment.
And Tiffany, going off that, just the fact that we have seen maybe the shift in sort of the risk that is posed right now to the economy, does the latest inflation print, does that almost give the Fed more permission to solely focus on or put more focus on, maybe is a better way to put it, on the jobs data? And what is your assessment of the labor market right now?
Yeah, I mean, so I guess the way that I would say it overall is that I think the U.S. economy is just finally getting back to a more normal state after the unique set of factors that hit it during the pandemic. And if the economy's back in a more normal state, then you don't need monetary policy to be restrictive. You need monetary policy to be back in a much more normal state, right? And of course, there's some uncertainty around what quote normal means for monetary policy, but it's probably not, kind of the almost 5.5% rate levels that we're seeing now. So yes, I think the Fed will start to ease back to where they think more normal levels of monetary policy should be in the long run. In terms of the labor markets, again, we do think they are easing. They're absolutely easing. We are seeing labor demand, which is easing, and that is healthy, just given the extreme labor shortages that we saw post-pandemic. And we're not only seeing this in the United States, but we're seeing it happen across the developed markets. So we're all just getting back to a more normal working environment, and again, that just suggests that monetary policy should also be more normal.
Last week, there was a lot of high hopes and probability for a 50 basis point rate cut. Do you want to see a 50 basis point cut from the Fed, or would you like to see an easing into that policy and that cutting cycle?
Yeah, well, I mean, I think, ultimately, usually historically, when the Fed has cut in these larger increments, it's because the economy is more clearly in recession. And so they've needed to not only get policy back to neutral, but they've needed to get it in accommodative territory. I think now there's a question around how quickly should the Fed just get back to neutral? As I mentioned, restrictive policy looks a little bit misplaced now relative to where the economy is. And there's certainly arguments for them to get back to neutral more quickly. I think at the same time, though, that, the Fed probably doesn't want, they certainly send signals in what they do. The market interprets what they do. And I think they want to be a little bit careful, not to, send negative signals about the economy in what they're doing. So, I think whatever they do, they're going to want to say, we think the economy is doing fine. Certainly things are slowing. And we think it's now time to return monetary policy to more normal territory. I think that's the way they will try to communicate this. I think that makes sense. And so whether they do, I think we think they're going to do 25, but whether they do 25 or 50, I think that's the more important piece is the communication on this.
All right, 25 is taking back the higher probability as of now, and we've still got some time until that next meeting. Tiffany Wilding, who is the PIMCO Managing Director and economist, thanks so much for taking the time here with us today. Vice President Kamala Harris has unveiled her economic plan this morning. She lays out key issues that she wants to tackle in her first 100 days in office, and she'll give a full rundown in a speech this afternoon, 2:45 p.m. Eastern Time, Raleigh, North Carolina. Here with what we know so far is our very own Ben Workshall. Ben, I'm not sure if you're in North Kakalaki yourself, but a lot of people are going to be waiting for those words to come from the Vice President.
For sure, I'll definitely be watching, and it's and as you mentioned, she's already released her plan, and there's three sort of main announcements to watch here, I think, for folks. One is the biggest one and the trickiest one is housing. We saw that this week in the inflation reading that shelter is still a big issue, and so she released a plan there, which has an overall goal of 3 million new housing units over the 4 years, and she accomplishes that mostly through tax breaks. The one interesting one on the supply side is what the campaign is calling the first ever tax incentive for building starter homes. So in other words, home builders making starter homes. Exactly how that works remains to be seen, but you would get a credit if you're building a home that eventually gets sold to a home buyer. There are also tax breaks on the demand side too, which I think will bring it in for some criticism, including a $25,000 tax credit towards down payments of first-time home buyers. So this is the kind of trickiness of the housing market overall that she's trying to tackle, as well as get votes for home buyers. Other initiatives to flag are grocery stores. That's a big area for her. Food prices, obviously a very big issue for voters. And what they're going to unveil is essentially what's called a federal ban on price gouging of food. That, again, that's another one that needs a little bit more definition, but it would be new rules that would make it illegal for food companies to raise prices beyond a certain set of rules. And then the third one is prescription drugs. You've seen Harris already talking about this week, but she wants to kind of keep going on lowering prescription drugs, Medicare negotiating. And one of their headlines that she's going to talk about this afternoon is about lowering the cost of insulin and lowering the cost of prescription drugs for everyone. Currently, the new rules in the last couple of years have done it for seniors, but this would be for everyone.
Ben, you mentioned two things there that I want to ask you about. When it comes to lowering the cost of renting and owning a home, and then also the plans for price gouging. It's two subjects that we know that Harris was likely to focus on here within this economic plan. I guess my question is to you, just in terms of your reporting and what you're hearing down in D.C., is there confidence that she's going to make a difference? Or I guess, how is she going to make a difference on those two fronts?
I mean, I think on housing first, it's a very open question, and there's a lot. She's already come in for a lot of criticism on this plan here, especially sort of demand side initiatives, which giving a tax credit to home buyers is clearly popular, but it could increase demand for housing, which some economists would say is not what you need right now. You need more supply. So she's got these kind of supply and demand sides of it. The issue is that the supply side takes longer. This is a credit for home builders who then would build the home and then sell it to home buyers, and then the supply would increase, but then the demand could increase more quickly. So that's one that's very hard to see happening very quickly, and also how it works is very much to be seen. The price gouging on grocery stores is another one. One thing to flag about this too is this is executive rulemaking, so presumably it could happen a little quicker. But again, there's the headline here is that there's a ban on price gouging for companies that have excessive profits. All three of those terms need a little bit more definition, exactly how big a ban this would be, what they consider excessive profits, and what price moves they would go. So this is the overall thing here. I think this is the first sketching of her plan, which we're going to see more in the weeks ahead.
Right. All right. Well, Ben, great reporting. Thanks so much for joining us here. And again, we will be hearing more from Vice President Kamala Harris. That's at 2:45 p.m. Eastern Time today when she speaks in Raleigh, North Carolina. Ben, thanks.
Thanks.
Coming up next, the media merger that just gets messier. We're going to tell you who might be the next bidder for Paramount on the other side of the break. Keep it right here on The Morning Brief.
Let's get to some trending tickers that we're watching here this morning. Shares of Applied Materials actually moving lower this morning right now in pre-market despite beating earnings estimates. The company had guidance that was in line with expectations. China sales did account for a smaller portion of the company's total revenue than projected. Actually, a good friend of the show, Stacey Rasgon, asked about China and the performance there that the company saw on that earnings call. Did see that. Also on the earnings call as well, the CEOs and the executives really confident in the future, as they should be and should hope comes to fruition, of AI. And, you know, that is just continue to be the case for a lot of semiconductor companies right now. But as they put it, this is the biggest tectonic shift of all is AI right now, and semiconductors providing the foundation for tectonic shifts in technology that are reshaping the global economy over the next several decades. For all you mobile phone users out there and the handset users, which is like everybody, LCD equipment spending remains low, but because they're becoming more confident in OLED technology found in smartphones and the bigger screens that we're using, that's where they're also going to be leaning into to try and get more demand generation out of that sector. So all you foldy phone buyers out there, just know that Applied Materials is waiting for you.
Yeah, and I think that within this earnings release that we got and the commentary that we got on the call here from AMAT, executives obviously very optimistic about where they stand in the AI race. They said, quote, "The race for AI leadership is fueling demand for our unique and connected portfolio of products and services." They also go on to say that it positions the company to outperform our markets over the longer term. And in terms of why we are seeing a bit of a reaction here to the downside, off just about 3.5% ahead of the opening bell, might be a bit of a surprise when you're just taking a look at these numbers at face value. But I think a lot of it has to do with that bullishness heading into this report, and then taking a look at the fact that the fourth quarter forecast, it was in line with expectations, which investors are viewing as a disappointment because they were looking for maybe a slightly bigger payoff on the AI spending part of things. So that is why we're seeing a bit of pressure on the stock here this morning. And remember that this is a stock that really has outperformed over the last several trading days. You're looking at a year-to-date chart, it's still up just about 30%. But even ahead of yesterday's earnings, the move to the upside yesterday ahead of the results was the 5% move ahead of those results yesterday. This stock rallied nearly 20% over the previous 6 trading sessions. So again, a lot of bullish activity, bullish sentiment heading into these results. So the fact that they did not raise their guidance, I think very much viewed as a disappointment here to the street this morning. Let's take a look at Texas Instruments. It's receiving as much as $1.6 billion in direct funding from the U.S. Commerce Department. It's doing that to support the construction of 3 new facilities. The administration is pushing for increased domestic production through the U.S. CHIPS Act, which was passed back in 2022. So yes, this is part of the CHIPS Act under the Biden administration. What this money is going to be used towards, I mentioned those factories. 1 is in Utah, 2 are in Texas, and those projects are expected to cost about $18 billion through the next 5 years, through 2029. It's expected to generate 2,000 manufacturing jobs, thousands more in construction, obviously, to build those manufacturing centers. Texas Instruments also went on to say that they expect to benefit from 25% tax credits from the CHIPS Act, and that could amount to $6 to $8 billion. So again, a further boost are expected to hear from the CHIPS Act that was passed under the Biden administration. So a bullish move here for Texas Instruments.
Texas Instruments saying we're more than just graphing calculators. In fact, they can build geopolitically dependable capacity for analog and embedded processing chips. What this boils down to, and you hit the nail on the head, more jobs. They needed this infusion of capital as well to, I think, really solidify for the investor community out there that they are too involved in this broader chips movement that's taking place. Of course, anybody who's been tracking Texas Instruments shouldn't be surprised at their play in the semiconductor space. I mean, there are perhaps parts of your vehicle at home, either sitting in your garage or maybe the vehicle that you're in, listening to Yahoo Finance right now, that have Texas Instruments chips in it. So all of that considered here, this just another infusion of capital that will help them steer towards some of the market share that they hope to take on more of in the semiconductor industry here. 300 millimeter semiconductor wafer fabrications that are going to be under construction in Texas and Utah here. So the Lone Star State and the Utah Jazz State, we'll call it. I actually don't know what Utah's state name thingy is, but anyway, we'll
get you the
we'll
answer.
circle back on that. But Utah Jazz, all the kudos to you guys for whatever. And the story keeps giving. We're still talking about Paramount? Yeah, we are. Paramount might get another bidder. Media executive Edgar Bronfman Jr. is preparing to bid for the entertainment giant and its controlling shareholder, National Amusements. That's according to the Wall Street Journal. Now, Bronfman formerly ran Warner Music and liquor giant Seagram. The Wall Street Journal reporting that the bid can come within the next few days even. So we got a little fisticuffs for Paramount here in the production there. My goodness, I only wonder what Skydance is going to do in reaction to this.
Yeah, and this is a saga that seems like it's almost never ending at this point. Here we are, weeks out from when they did reach a deal with Skydance, and here we could potentially have a new bidder. So what does all this mean? The deal is subject to a go-shop period, that deal with Skydance, with other potential buyers can make those offers. That actually ends on August 21st, so later on this month. If Paramount chooses to go with another offer, that means that they are going to have to pay Skydance that breakup fee of $400 million. That's all according to the securities filing. Again, this is contingent on the fact that Paramount would get another offer and then go with the other offer. That is what they would have to pay then for Skydance if they were to abandon that deal. In terms of who Bronfman has held talks with, reportedly has held talks with the Fortress Investment Group, Roku, Hollywood producer Stephen Paul, who had previously expressed some of that interest in the bid here for National Amusements. So we will see how this all plays out.
Yeah, I mean, and what ultimately is the biggest delta for the consumer right now, because there are so many different tiers that consumers have had to wade through trying to figure out, do we want advertising for a lower price or do we want no ads for a higher price? Oh yeah, plus I'm paying extra for live right now. Maybe that's just a personal quip or a problem that I'm working through mentally and in my own finances. But all of these things considered, with the different tiers that have been put out into the market, it's offered more of an opportunity for the media companies to tap into the digital advertising landscape and get even more of those dollars that would have traditionally gone to cable and linear and bring those over into a platform where they can get a little bit more targetability as well. So good for advertisers, good for the media companies that are offering these streaming options as well. But for consumers, the pricing tiers, that's going to be extremely competitive going forward. At what point do we just get to this pricing tier that it makes more sense to have just kept cable at a certain point? So that's, I think, what we're going to see play out here is what that pricing optionality is.
Yeah, certainly. As we count down to the opening bell on Wall Street, you're looking at stocks losing a bit of steam as we wrap up the trading week. Some disappointing data out before the bell on housing is adding to that downward move here that we're seeing almost across the board.
I mean, look at this. You got Smokey the Bear ringing the opening bell at the NASDAQ. I mean, what more could you ask for? Funfetti in the air on a Friday? It's his birthday. He's a Leo. Wow, we love that for Smokey. Let's take a look at the NYSE as well. I think you had Q2 ringing the opening bell there. You know what? Forget it. Stay on Smokey there for a hot second here. Oh, by the way, just a little bit of circular reporting here. Our control room has confirmed that Utah is indeed the beehive state. Beyonce would be very happy. Perhaps there's a Utah-specific tour. Maybe not. That should be rolled out. But anyway, we'll see. That's the opening bell. Let's take a look at the major averages here. We're down across the board. We saw this in the futures activity. It's been a pretty good week of data coming in line with expectations more largely here, really staving off some of those concerns that we had seen from the labor data that had come out in recent weeks and really pushed a lot of the investor, or at least the probability that we might see a 50 basis point cut. That's since abated. That's down at like 25%, where 75% probability towards a 25 basis point cut come September here. But the markets, they've been trying to march back from some of the volatility that we saw to kick off the month of August. By the way, Mercury did go into retrograde as we were seeing some of those deep sell-offs. Got something for the horoscopes.
Yeah, something to, I guess, think about here. Maybe it tells us a little bit more about the direction that we could be headed. Let's kick it over to Jared Blickery. And Jared, we're looking like we're giving back some of those recent gains here in early trading.
Just a little bit. And happy birthday, Smokey the Bear. Let's take a look across the board here. Aside from the U.S., mostly green. I'll even to point out, look at Tokyo. It's up 3.5%. Korea's up 2%. So that's really a chip-heavy trade over there. Let's focus on the U.S. and the week that was. Really solid and some pretty big gains. It's going to be the best week for the S&P 500 and the NASDAQ if we were to close here since last November, I believe. This is a 5-day look at the Dow, up 2.5%. Here is the NASDAQ up even more, getting towards 5%. And then here is the S&P 500 up about 3.5%. Want to point out, too, that from the 8.5 lows, that's the August 5th lows, we are now, well, that's not going to be it. Let's see if we can find the 12-day and the 9-day. There we go. So on the 9-day, we are up 6.5%. And then this is a 12-day chart. This is for the month of August. We are actually in the green now. So the S&P 500 climbing back into the green. Very notable because that was not the obvious case a couple weeks ago on that fateful Monday. Here's a look at the VIX. Guess what? The VIX is now underwater over the month of August. And you can see there's that big spike up to 65, but it came crashing back down and has now slowed the descent, but it's still edging lower there. Let's take a look at some of the sector action, and tech has been the leader until today. Today it's a laggard. But let's take a look at the 5-day, and we can see tech and consumer discretionary, the only outliers or the only outperformers here. Tech up 7%. And let's get a gauge on the month of August. You can see Staples is the leading sector, so is healthcare, utilities, real estate. Not surprising because those are defensive sectors. Those did not lose as much as the tech sector did when we had that huge sell-off. And then just looking real quickly at our leaders, we're seeing more red than green here. And this is for the month of August, but let's dial it back down for the week, and we can see chip stocks. Chip stocks leading the way, up 8%. ARK is up 5.7%. That's the ARK Innovation Fund. Looks like Momentum doing well, Magnificent Seven, gambling. The list goes on. But all in all, very, very constructive week here, guys.
All right, Jared, thanks so much for wrapping that up for us again. At least here in early look and early trading, we're seeing some pressure across the board. Keep right here on Yahoo Finance. We've got much more coming up. Again, you're looking at losses across the board for the S&P, the Dow, and the NASDAQ. Some pressure here on stocks on the heels of that disappointing housing data that we got out before the bell. More on that when we come back. Stocks losing some steam in the final trading day of the week, pressured by disappointing housing data out before the bell. But for the week, though, it's a very different story. The S&P 500 and the NASDAQ are both still on track for their best weekly performance in nearly a year since last November. For more, we want to bring in Emily Rowland, John Hancock Investment Management's co-chief investment strategist. Emily, it's great to see you again. So talk to me about this bit of a reversal. Obviously, taking a look almost 2 weeks ago at this point, we had a massive sell-off, some of that sparked by concerns about deterioration in the labor market. And then, of course, you had the unwinding of the yen carry trade. But here we are almost 2 weeks later, and it looks like there's a lot more optimism playing out in the market. What does that tell us just about where momentum lies?
Yeah, it certainly feels like a distant memory, Shauna, that sell-off that we saw a couple of weeks ago on growth fears. What we have right now is a reversal in sentiment where good news is good news for markets. So good news on the economic front. We saw CPI coming in line with estimates, PPI, which actually kind of stole the show over CPI on Tuesday, coming in much lower than expected. So that disinflation narrative is still intact. At the same time, you saw some slightly better data across things like retail sales, suggesting the consumer remains intact. You saw initial jobless claims, which had spiked the previous week, slowing down, again, suggesting that the labor market is holding in there as well. So it certainly feels like a good news is good news environment. The Fed's still on track to potentially cut rates. We think it's 25 basis points in September. Which is kind of a, preemptive cut, which the market loves. And it's really reviving hopes that we can have this soft landing play out.
And it's reviving some of the buy the dip mentality as well. That's permeating very strongly right now. Emily, where are some of those opportunities that you're seeing investors really flow into?
Yeah, it's pretty interesting to watch. Risk taking is certainly coming back into fashion this week. We've seen small cap stocks surging. A lot of those are unprofitable. They're lower quality. We do want to fade that. We're seeing, again, a weaker dollar, which is a bit of a surprise given the fact that the data overseas is actually worse than it has been in the United States. That's spurring risk taking and causing a rotation in international equities. So more cyclical areas of the market, more risk on trades happening, momentum taking center stage here. We would actually be looking to prune risk, looking for higher quality areas of the market, companies with great balance sheets, tons of cash, good return on equity, an ability to maintain margins in an environment where we think margins are going to be shrinking from here. We're finding a lot of that in mega cap tech, which frankly is where the earnings is. Looking at earnings year over year, small caps are actually negative 16% year over year earnings growth, where large caps have held in there. The tech space alone this quarter coming in at 18% earnings growth versus 11% for the S&P 500. So the fundamental story around tech is there, but of course it's still expensive. So we're looking to diversify from tech with other areas that are on sale, but still offering quality.
Emily, is there anything just in terms of the data that we've gotten out recently, or even within the fundamentals, some of the stuff that you were just talking about, that is a risk or could derail some of the sentiment? Because it doesn't seem like that is the case now.
Well, the challenge, Shauna, is that right now the music is still playing, and it really doesn't stop until you see a spike in initial jobless claims, which comes together typically with high yield bond spreads widening. So one of the features of the market sell-off that we saw last week was that high yield bond spreads jumped to about 380 basis points, and now we're back down to 320, which is well below the 20-year average of 500 basis points. So that's just a fancy way of saying that the credit markets are telling you there's no problem whatsoever here, no chance of a liquidity event, a financial accident, everything's fine. Defaults will remain low. What you typically see are these are the two of the most timely indicators. And once they spike, and it can happen quickly. In fact, Austin Goolsbee talked about this morning, that the labor market deterioration can happen really quickly. It's usually too late to adjust portfolios. So the music is loud right now. Everybody's still celebrating disinflation. Investors love it when inflation comes down. But we have to remember that there's kind of a nasty side effect to inflation moderating, which is that profit growth is slowing. So revenue growth, which was awesome when we had inflation because companies could pass higher prices along to the end consumer, revenue growth is slowing at the same time that costs are still elevated. So companies' margins are being contended with right now. And if you want to maintain profitability, you've got to defend those margins, and that typically involves cutting costs. And as we know, the biggest cost that most companies have is labor, it's people. So the last shoe to drop in every economic cycle is that the unemployment rate or initial jobless claims sharply move higher. And it's tough to anticipate that because it happens so fast. So that's the reason we want to lean into higher quality assets and look to bonds to do some more heavy lifting in portfolios from here.
Yeah, it certainly is loud out there. I mean, so much so that the decibel level indicator on my Apple Watch is going off right now, Emily.
Yeah.
But one area that it is increasingly quiet is the mentions of recession on earnings calls over this past season. And one of the huge things that we're tracking from companies is how they might be talking about that earnings growth if we were to see, as Austin Goolsbee is talking about this morning, the warning signs of recession. What are your anticipations there? What does this mean for real earnings growth in the back half of this year?
Yeah, I mean, it's, the economy's doing fine. We're chugging along here, but we do think that we are seeing a slow deceleration, which ultimately will result in more cracks in the labor market. And you're seeing it through some of the earnings results from some of these consumer-driven companies. We're looking at delinquencies picking up, that lower-end consumers under pressure. Credit card interest rates right now are over 20%. I mean, that is remarkable in terms of the cost of capital that's in play for consumers today. So we really want to watch that deceleration. Again, it's happening slowly. We're not hearing as many mentions of recession, but we want to be careful here. It just means owning higher quality assets, locking in the income that's available in bonds today. The aggregate bond index now yielding close to 5%. We would look to deploy the incredible amount of cash that's sitting on the sidelines right now and embrace those higher quality bonds because we have an opportunity now to lock in those yields, which we see falling over the course of the next 12 months or so.
Emily Rowland, who's the John Hancock Investment Management Co-Chief Investment Strategist. Emily, great to see you as always. Thanks so much for taking the time. Coming up, everyone, could we see a bipartisan supported crypto bill passed this year? We'll have more when we return.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action.
And explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. Bitcoin falling below 59,000 right now, trading just around the lowest level that we've seen since the market panic earlier this month. For more on that recent move lower and where we could be headed, we want to bring in Owen Lau. He is Oppenheimer's executive director and senior analyst. Owen, it's great to talk to you. So when you take a look at some of the pressure, obviously, that we've seen from Bitcoin most recently, going back 2 weeks, obviously, we saw Bitcoin get a little bit caught up in some of that panic that we saw sweep Wall Street. Now here we are almost 2 weeks later, and we're seeing downward pressure once again. What do you attribute that to?
So first of all, thank you for having me. I think that was attributed to people pay a lot of attention to macro factors. You just talk about the weak July jobs number, the unwind of yen carry trade, and people just pay too much attention to those macro data points. I do feel like sometimes people forget about there are use cases for blockchain, which is making the remittance and global transactions faster and also cheaper. But right now, here we are, after we saw the massive sell-off 2 weeks ago. We saw like Bitcoin, I think at one point down 17%, and now it will go back up to like almost $60,000.
I mean, it's interesting, Owen, because you have a lot of the crypto community online speaking about the confiscation of $2 billion worth of Bitcoin by the Justice Department from the Silk Road dark web market here. And we've seen when there are big transfers like that are government related, that there are huge drawdowns in the price and the price action of Bitcoin. To what extent is that playing a role in what we're seeing today?
I think it did play a small role because whenever you heard about, government, Germany, US sell some Bitcoin or crypto assets, usually it puts some downward pressure. But I do want to remind people that if you look at daily transaction for Bitcoin, I think it's like in the magnitude of like $30 billion per day. So if you just only talk about $2 billion of transaction, this is only one time. And over time, I think the market can easily absorb these kind of downward pressure and the sell. And that's why we only see that volatility. And we saw a big drop in one day, and it quickly rebound back to around $60,000.
Oh, and how much is riding when it comes to the future of crypto, the likelihood of regulations? We heard Senator Chuck Schumer promise, or very optimistic maybe, that we could see some sort of regulation on crypto before the end of the year. But looking beyond 2024, how much of the future of crypto is riding on the election? And is one candidate, one nominee, better than the other when it comes to the future of crypto?
So I would say around a few weeks ago, I think people felt like there was a lock for Trump. And now you see that there are more pressure on the Democratic Party, and Chuck Schumer, just like you said, 2 days ago came out and talked about crypto. It's here to stay, and we need to develop forward-looking regulation. And I think overall it's good for the industry. It shouldn't be like partisan issue. It should be a bipartisan issue because, again, this is about the technology. It's not about the party issue. But going back to to his comment, I do feel like I'm optimistic that there will be more regulatory clarity in 2025, but getting past the bill this year, if I have to assign a probability, I would only assign a 20% chance at this point.
Oh, and we only got about 30 seconds left here, but just following along that same kind of thread of the conversation, if we hear about Bitcoin on a presidential debate stage, what should those who are holding or those who are investors in crypto be listening for most closely to understand how the next 4 years could look like for the digital asset?
I think it's not just about what they talk about, said about Bitcoin and blockchain. I think it's more about the detail. How much detail they know about this industry. That would determine the direction for the next 4 years or so. So again, look for the detail, not just they talk about Bitcoin and blockchain.
Owen Lau, who is the Oppenheimer Executive Director and Senior Analyst. Owen, great to see you. Thanks so much for taking the time.
Thank you.
Stay tuned, everyone. We're taking a closer look at what's trending on the Yahoo Finance platform, yahoofinance.com. That's right after the break. We're taking a closer look at Yahoo Finance's trending tickers. We've got Bayer, Estee Lauder, and H&R Block. We're doing it in 30 seconds or so each. Let's go. Bayer shares, they're surging. An appeals court ruling the pharmaceutical giant has limited ability for not putting a cancer warning on Roundup labels. There you're taking a look at shares of Bayer right now, higher by 11% here. And of course, the manufacturer of such things, including Roundup. Roundup has been tied to some class action suits around its, Bayer has been around Roundup, rather. And so that's where the appeals court is ruling in favor here, unfortunately. We're at time? My gosh, just put a timer up there. Anyway.
All right, well, let's move on to Estee Lauder because this is a stock that's on the move here this morning. We're looking at a downgrade from Bank of America. The company is citing some weakness out of China, soft U.S. demand as potential headwinds here, or as headwinds for the beauty company. You're looking at losses of just about 0.1%. Now, these are two issues that were brought up on the most recent earnings call here from Estee Lauder. They actually cited some improvement in both of those areas, but when it comes to the forecast and what they have been expecting, they did expect organic sales to fall 1% to 2% compared with the previous estimate of a 1% decrease to a 1% increase. So again, on the heels of that and maybe further deterioration within those businesses, Bank of America at least seeing a reason to downgrade the stock.
Hey, you met the number there. All right,
Really,
H&R
but
Block.
tried.
Yeah, I know. I'm going to try here too with H&R Block, I promise. H&R Block shares rallying. The tax preparation company reporting better than expected earnings in its fourth quarter report and hiking its dividend. And stay tuned. We're going to be speaking to H&R Block CEO Jeff Jones in our show Wealth at 11:15 a.m. You don't want to miss that. That shouldn't count towards my time. However, I will add this. They said that in addition, today's announcement of a 17% dividend increase plus new $1.5 billion share repurchase authorization reflecting the support of their strategy and confidence in the future.
You nailed it. Right? You got
Yeah.
it before the buzzer. All right, we're going to
Skin
get
of
a
my teeth.
countdown clock on these days. All right, coming up, stocks are lower after soft housing data this morning, but still on track to end the week in the green as the week of data and earnings point to a resilient consumer, at least for now. We're going to be getting more retail sales numbers out or retail earnings out next week. We will get another read on the consumer with consumer sentiment out at the top of the hour. We'll keep it right here on Yahoo Finance. We've got all that coming up for you on Catalyst.
We should get one of those little timers that they put in the Taboo game.
And
Just the sand one, you just flip it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
we're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today. Econ data is really driving the early action here this morning. Better than expected consumer sentiment data, reversing some of the earlier losses that we saw. You're taking a look at the Dow, now in positive territory. The S&P just above the flat line here as it flip-flops just along the flat line. You've got the NASDAQ, though, still under pressure. We're going to break down what today's econ data signals for the path ahead.
And Vice President Harris is set to outline her economic agenda in her first set of public policy proposals since announcing her candidacy. We're going to discuss the potential implications for inflation and the path forward.
And Meta receiving a letter from lawmakers encouraging the social media giant to eliminate illicit drug ads on its platforms. This comes amid a broader crackdown on big tech, including a move from the DOJ to potentially break up Google. First, though, we got to get to some breaking news out, and that is consumer sentiment data released just moments ago. And taking a look at what we are getting here, what did come in better than expected for the most recent reading. Now, remember, this is a preliminary reading. That sentiment rising to 67.8. That was above expectations here. The current economic conditions index, though, that did fall to 60.9 from the 62.7 reading last month. When you take a look at expected changes in median prices during the next year, that was flat, unchanged at 2.9%. But when you take a look at a longer term timeline here, the next 5 to 10 years, that was also unchanged, Maddie, at 3%.
Yeah, just to run through some of the superlatives here, we have sentiment coming in at the best number and the headline since June here. Current conditions weakest since December of 2022. And I'm also seeing that it's still the lowest one-year inflation expectations that we've gotten since December of 2020. That one-year expected inflation number coming in at 2.9%. That's right bang in line with the expectation, though. You're seeing still some pressure across the screen. It's looking like a little bit of a reversal after that weaker than expected housing data. We saw an initial bump up off the heels of this consumer sentiment. Now we're just around the flat line, but it's still higher than the market was earlier in the day off of the heels of that housing data that we got coming in. So we'll see if the sentiment data is enough for stocks to continue to kind of wipe out those losses from earlier today. Well, let's continue this conversation around the consumer because, again, markets digesting that economic data and stocks still looking like they are in recovery mode off of that better than expected consumer sentiment data, putting the S&P on track for its best week of gains since 2022. From on this, we've got Drew Pettit, a U.S. equity strategist at Citibank. We've also got Chris Versace, the Chief Investment Officer at Tematica Research. Guys, thanks so much for being here. Drew, I want to start with you. So it's interesting to me, the market kind of turned on the housing data this morning. Now it's turned a little bit again, but not to the degree that it was heading into the pre-market today. What does that tell you about what the market is kind of trading on right now and the amount of conviction in the market?
Honestly, I think we're starting to price out the recession tail risk right now. Even if we have economic growth slowing in the next couple of quarters, I think the market's comfortable that we're potentially not going into a really deep and prolonged recession. So I think even for some of the consumer stocks that didn't really have great earnings, the market and investors are looking through that to the other side and then balance that with, Fed cuts seem very imminent, and that's been really good for the growth side of the market. So again, markets looking through some of the softness, they're pricing out recession risk. I think that's really healthy, and we have a much more balanced setup from here.
What do you think, Chris? Do you agree?
Yeah, I do. When you look at the data that we're getting, it seems to indicate more of a soft landing. We've been bouncing back and forth between, fears of a recession, given some of the early July data that we got. And then yesterday, kind of a snapback. The economy's okay. The consumer's okay, even though I have some concerns with that July retail sales figure. But overall, it's kind of supporting the soft landing narrative that the Fed has really been targeting. And I totally agree that, we are that much closer to rate cuts, and we're starting to look through what are the implications of that as we not just get a first rate cut, but really as the Fed enters what is likely to be a rate cutting cycle. And the market, as we all know, looks, 6 to 9 months ahead. So folks are starting to say, what does that mean 2-3 quarters out?
Chris, what are your concerns around the retail sales data that we got yesterday?
So if we take a look at some of the events that happened during the month of July, Amazon's, Prime Day and competing efforts, Walmart, Target, I'm just a little concerned that we saw some pull forward from August and the back to school shopping season, just given the really robust numbers reported by Amazon, that when we get the August retail sales number, instead of seeing a month over month increase like we historically might, we might actually see a negative number. And that can lead to some further incremental downward revisions for GDP expectations for the current quarter.
We're going to get to both of your kind of post-pullback shopping lists. Drew, I stole that from you. But just to get one more inflation question for you in, I know that you've got a house call of 125 basis points of cuts and that recession is not in your base case. You mentioned that earlier, too. I'm not going to question your colleagues on the econ desk, but what questions does that call prompt from clients just about how to position for that degree of cuts without a view of a bigger economic concern?
This is always a tough one because some people think you need the economic weakness to get the cuts. And again, the soft landing or no landing narrative is really inflation's come in. So when we talk about positioning, we still like barbelling, but because we don't think we are going into an earnings recession, again, not to talk about our econ colleagues and their view of the world, but if earnings are resilient on the growth side of the market, we want to buy that for defense. And we want to barbell that with cyclicals and the rate sensitive cyclicals like financials and consumer, which should benefit out the other side. So it's basically anything but defensives. And that's honestly been our stance for most of the year.
So, Drew, what does that tell us then just about positioning? Because you correctly called the pullback that you had been expecting in AI stocks. We certainly saw that. Now here we are today, and we certainly have seen a bounce back. Many investors out there buying the dip that we had seen over the last 2 weeks. How do you think they're positioned today? And what does that then tell us about that further positioning for investors?
Well, breaking news from our team as our updated weekly sentiment index just hit, and that just came back to neutral. So with the market pullback, especially the more aggressive pullback on the growth side of the market, sentiment looks much more balanced now than it did heading into this month. So that's number one. And then number two, like talking about the growth side of the market and AI stocks and our view there, because those have come in more aggressively, you're starting to see implicit growth expectations that actually look much more attainable now. So you can start legging into some of these names like an Apple, an Amazon, an AMD, or even a Marvell. So again, much more balanced setup, growth side looking incrementally more attractive here.
Chris, 30 seconds here. You also bought Marvell on the dip. Why is that your chip stocks pick?
Real simply, we're starting to see the upgrade cycle for PCs and smartphones that are going to drive a AI-enabled explosion in content creation consumption. That's going to pressure the digital infrastructure, which is the other side of Marvell's business outside of data center, which is already benefiting from strong spending from big tech. So we see all of Marvell's businesses strengthening into 2025.
All right, Chris Versace, always great to get your insight. Drew Pettit, we really appreciate you taking the time. Thanks to you both here for breaking down the latest moves that we've been seeing in the market. We with the S&P 500 and the NASDAQ both in positive territory for the month of August, despite that sell-off that we saw earlier last week. Stocks buoyed by recent econ data. So are markets recovering, or is this just a dead cat bounce, which is a short-term recovery in a declining market? Our very own Jared Blickery has done the technical analysis and is here for more. Jared.
All right, let's take a look at what a dead cat bounce is. No animals hurt in this process here. It is a temporary small recovery in the price of a declining asset. often seen in a bear market that is followed by a continued downward trend. It can mislead investors into thinking a market has bottomed. So if you're paying attention to the definition, it sounds like you only know if it's a dead cat bounce with hindsight because it essentially fails. So let's take a look at the current price action here and see where we are in the S&P 500. I'm going to show you a 2-month chart with candlesticks, and I do like candlesticks because they allow me to see inflection points very easily. You can see the open, the high, the high, the low, and the close in each of these bars. This goes back 2 months. So this right here is the all-time high, just short of 5,700. This right here is the most recent low by about 5,100, and all in all, I don't even think this was a 10% decline. So this is pretty mild by historical standards. But we got a very, very steep sell-off on some very scary things happened internationally with the Bank of Japan and the carry trade. And we got this big down series right here at the change of the month. Bam, bam, and then we were down to these lows, and it was looking pretty scary down there. A lot of people say buy the dip. Well, it's not always easy once you get the dip because, well, the VIX hit 65 at that level. But what's happened since then, it has clawed its way back. And the first hurdle was getting past this prior support point, which was able to do on this day right here. And then 2 days later, it was right back up to this resistance level where it is right now. That is still resistance. If it punches above, you can see it's probably an easy bet that it gets back to those record highs and at least ties it. But the key moments here are really the clearing of some of these levels in here. And that determines, in my point of view, whether or not it is a dead cat bounce or not in the making. And that's what we want to figure out in the making. Another point on this capitulation low right here, I'm calling it a capitulation low because in the market internals inside the S&P 500, you had a record amount of volume on down stocks that day. So while it wasn't a disaster, this was only a few percentage points moved down. We've seen the Dow down 1,500 points. We've seen 5% down days. That was not it. But when you look inside the market, that was probably a capitulation event that chased out all the remaining bears. And then with no more firepower at the lows, it had no choice to go but up. Guys?
All right, Jared, thanks so much for breaking that down. A couple of key levels to watch here as we look ahead to the rest of today's trading action, but of course ahead to next week. Keep right here on Yahoo Finance. We got much more of your market action ahead. Again, now you're looking at a mixed picture. You've got the S&P and the Dow trading just below the fly line. You've got the NASDAQ, though, holding on to slight gains. Much more coming up on Catalysts.
Let's take a look at markets right now. The S&P 500 and the NASDAQ are still on track for their best week of the year, recovering from those losses suffered during this month's sell-off and reversing some of the earlier pressure that we saw in stocks after that housing data. Now, the Magnificent Seven in particular added $1.4 trillion in market cap from its lows back on August 5th. CFRA Research Senior Equity Analyst Angelo Zeno is joining us now for more on what's going on with these tech stocks. So, Angelo, today withstanding, talk to me about the kind of rebound that we have seen in tech stocks over the course of the last week following that sell-off. Do you anticipate this being a narrative that's going to have some legs?
Well, thanks for having me. So when we kind of look, from the August lows, obviously tech has really kind of led the way here. Not necessarily a surprise because tech is still actually the worst performing sector since that July peak that we saw about a month ago. Now that said, we've clearly kind of driven the decline, or the area that saw the biggest decline was semis. And the area that's kind of seen the biggest kind of whipsaw back also has been semis. But semis, corrected about 29 to 30% peak to trough, almost unheard of. I mean, that's not something you typically see, out of the group unless we're kind of in some kind of massive, cyclical downturn, which we're not at this point in time. So with NVIDIA kind of leading the way up here, our view is we're going to see more choppy action kind of following this kind of big, kind of surge back up here. I don't know if you necessarily kind of, get through those highs again here anytime, over the next kind of 3 to 4 weeks. But our view is going into kind of the next 2 to 3 months, expect more choppy action, at least kind of going into this election here. And then kind of the final 2 to 3 months, I think, gets a little bit more interesting here for tech.
What is that catalyst then? Is it not NVIDIA's earnings? If you think we're going to be maybe in more choppy action then for the next 2 to 3 months, I guess how should investors then be looking for some of those buying opportunities?
Yeah, no, so I think it's a good question. So when we kind of think about, what typically drives tech, it's higher earnings potential, right? And when you kind of think about over the next couple of, call it next 6 to 9 months, we think kind of the two most important product launches that are going to be out there is going to be NVIDIA's Blackwell launch, which, for all intents and purposes, look like it's somewhat delayed or pushed out here to an extent. And the other one is the iPhone 16 cycle. Those are kind of the two product launches where we think you could potentially see more upside to those consensus estimates. As far as NVIDIA, with everyone kind of eyeing the August 28th date with their earnings release, it all depends on where the stock is going to be sitting at that point in time. But given the run-up we've seen here now, our view is that with the push out on Blackwell, you probably don't see the pronounced beat and raise that you could have seen until the following quarter. But that said, I mean, we expect a pretty good result here when they do report. Demand continues to exceed supply for their Hopper GPUs, so the results should be good. The guidance should be fine. It's just not going to be some sort of blow off type of guidance, we think. So I think this is one of those situations you keep holding on to kind of those type of names out there, specifically our favorite kind of Mag 7 names, but don't expect anything too extreme here, at least in the immediate near term.
I'm curious about your thoughts on the guidance, because that seems to be the sticking point issue for a lot of these chips names so far. That's exactly what the issue was with AMAT this morning, beating on several different estimates, but just coming right in line with expectations and the street punishing them for that. To what degree do you anticipate a softening of market expectations for chip stocks in particular as we head into the next quarter of earnings, given how this quarter has gone so far?
Yeah, I mean, it's interesting because the Q2 numbers were definitely somewhat mixed in nature, whereas, some of those high growth names actually came in, fairly okay, in line to slightly above expectations, and kind of the more cyclical oriented names, your industrial automotive type names out there, coming out a little bit light on that side of things. I think as you kind of go into this next quarter, going into Q3 earnings season, it's still too early to really kind of tell what the expectation is out there. But when we kind of look out there, I mean, I think the setup is okay, as long as kind of these stocks don't get ahead of themselves again like they did in July. But yeah, our view is expect a 2025 that is going to be pretty good. The problem becomes on a valuation side of things, where are we going to be sitting at as the cycle kind of gets longer, and especially from kind of these these higher growth AI oriented names. So But our view right now is, all things look okay from both a valuation perspective and from a fundamental perspective.
So, Angelo, given all that and kind of to wrap this all up and make this actionable here for investors, they're looking to put money to work. They're trying to figure out who is best positioned at this point. What are your top picks then?
Yeah, I mean, for us, it continues to be, select high growth oriented names. We do like Marvell a lot at this level. Over here, I mean, it is a name relative to some of the other high growth names that have underperformed. And you kind of look at what Cisco did here, announced earlier this week. We think some of their kind of more depressed type of end markets like carrier infrastructure and stuff like that have kind of run its course on the downside. So we now do see kind of upside potential in terms of those expectations where their AI-oriented businesses continue to run very well. So a name like Marvell kind of going into the results here over the next 2 weeks or so should be very good, as well as Broadcom, for similar reasons as Marvell. And then, NVIDIA and AMD are still two names that we do continue to like. We liked it a little bit more a week and a half, 2 weeks ago, but we still like these names on the recovery here. Maybe the upside is a little bit less than we clearly saw a couple of weeks ago.
All right, Angelo, thanks so much for hopping on with us this morning. We always appreciate you. Angelo Zeno, CFRA's Research Senior Equity Analyst. Thanks.
Yes.
Let's get to some trending tickers that we are watching this morning. Starting off with Rivian. Shares under pressure, down over 2% after the company temporarily suspending production of its commercial delivery vans that are used by Amazon. Now, they say this is due to a shortage of certain parts, according to multiple reports. And the production halt is really just the latest in a series of supply chain issues for Rivian that have come over the past 2 years. Amazon has already responded for their part in this, saying that they're aware of the concerns around production issues. They don't expect an impact. Rivian has a deal for 100,000 of these vans being supplied to Amazon by the end of the decade. They've already got about 15,000 in use. So the big question is whether or not that is going to be able to continue in the short term. It's not necessarily likely to negatively impact Rivian earnings moving forward, but it does play to that broader narrative of Rivian struggling to keep up with their own supply chain. And this is something that came up in their latest earnings print. After their earnings results earlier in August, the stock went down about 10%. They were not able to hit analyst expectations for second quarter revenue, and their cash burn was also higher than anticipated.
Yeah, I think there's still a lot of questions because we didn't really get too many details from Rivian just in terms of what exactly that part is, where we are seeing that shortage. They're very confident in fact that they are going to make up for this lost time, but they didn't really give a timeline of exactly what that would be. So I think some of that uncertainty and lack of clarity surrounding this delay is really what's putting pressure on the stock, and off just about 2% here in today's trading. Remember that Rivian also produces all of its vehicles at that one factory in Illinois. They do have a second factory planned for Georgia, but right now they do produce all of their vehicles at that one factory. So they are saying that some of the workers that are being affected by this do have the opportunity to continue their work at that factory. But again, lots of questions about what exactly that timeline looks like, where exactly that shortage or what the part is that they're having shortage issues with, and then exactly how long it's going to take to maybe get back to those original estimates. All right, keep right here on Yahoo Finance. We've got much more of your market action ahead. Again, just about an hour into the trading day. You're looking at the Dow now off just about 0.1%. The S&P just below the flat line. The NASDAQ still holding on to slight gains here this morning. Much more coming up on Catalysts.
busy year for activist investors. 2024 already seen 2.4% more campaigns than the previous year. That's according to EY. Starbucks and Southwest Airlines among the most recent names to come under activist investor pressure. Here with more on what's fueling the activism environment, we've got Columbia Law School professor John Coffey. John, thanks so much for making time with us this morning. Just start us off giving us kind of your broad picture on why you think we're seeing this increase in activity right now. What is it about this moment that's fueling this activist investor sentiment?
Well, I think there is a great uncertainty and a great amount of market volatility. We're looking at two different stories. They both involve a common actor, Elliott. Elliott's one of the best known, most activist large hedge funds, but it plays very different roles. And I'd have to say that in the Starbucks story, the board is the hero of the story. The board saw there was a problem. They saw their new CEO had stock price decline. It persisted for 16 months. They decided they had to get someone new, and they went out and made basically a terrific choice, the CEO of Chipotle, which was probably the most successful of the food service companies in the market today. All of that worked very well with only minor involvement from Elliott. In contrast, in Southwest, we see the same actor, Elliott, making a controlled bid. It's actually running 10 candidates for office for election of the board. 10 seats, an absolute majority, would give it control. That's very unusual. Activist investors usually seek 2 or 3 seats because that's all that institutional investors who hold the majority of the stock will tolerate. The one pretty much of an iron rule among institutions is they don't want to give anyone control without getting a control premium. So if Elliott can elect 10 directors, I will be surprised. They don't want anyone in control. The institutions want to hold the balance of control.
John, why do you think we're seeing a different approach then when it comes to Southwest? And in order to maybe gain support for Elliott management to get some support,
it is something of a mystery.
Yeah,
because Southwest keeps saying, we asked them to meet with us. We want to meet with them. Tell us what you think we should do. We'll talk about it. And Southwest has not been static. It's changed its basic business model, and it's willing to discuss other changes. But according to Southwest, Elliott won't tell them anything substantive about what changes it would like to make. That's not the way most activists work. They usually have pretty clearly defined goals, and they usually don't include trying to get absolute control because institutional investors tend to resist that.
What does it tell us then when you see a company like Starbucks? Some could describe it as capitulating to activist investor sentiment by changing its CEO. What does that mean about the company itself and the strength of the activists?
I think it does mean that the old CEO was not successful. He wasn't moving Starbucks enough. But when they moved to the new CEO that the board itself found and recruited and brought in, the stock price went up with a big surge. There's been a 14% at least market surge since they announced the change in CEOs. And that's success for a board. They've done it without extreme pressure, and they've gotten probably the best candidate that was out there in the market if you look at what CEOs had recent success in a very uneven market.
All right, Columbia Law School professor John Coffey, always great to have you. Thanks so much for joining us here this morning with some insight into some of that recent activist investor activity that we've seen. Well, historic changes coming to the housing market this weekend. New rules going into effect on Saturday, transforming the way realtors get paid to help people buy and sell their homes. To discuss if the rule change could be a catalyst for the housing market, we want to bring in Ryan Tomasello. He is KBW's managing director. Do we have Ryan, guys? Okay, we don't have Ryan. We're going to try and get him up here. So give us a few minutes. We're going to head to break and we'll be right back. Historic changes coming to the housing market this weekend. New rules going into effect on Saturday, transforming the way realtors get paid to help people buy and sell their homes. Here to discuss if the rule change could be a catalyst for the housing market, we want to bring in Ryan Tomasello. He is KBW's managing director. Ryan, it's good to see you. We first talked to you when we got this ruling several months ago. So now here we are with the law set to go into effect tomorrow. How big of a catalyst is this a catalyst for the housing industry, and why or why not?
Yeah, the day's finally here. I think, what we've said from the beginning is that this is going to take time to really see how this plays out in practice on the ground once these changes start to get adopted. Ultimately, we think over the long run, this is going to provide a lot more transparency for home shoppers. It's going to allow more agents to compete more heavily on price and quality. But over the near term, I think it's probably going to be a bit of a bumpy road as the market digests these changes in such short order, and also at a time when the housing market itself has a laundry list of complexities around it, from rates to supply. So it's going to be interesting to see how these rules get adopted over the next few weeks.
Talk to me about your call on how inflationary this change might be, Ryan, because from our perspective on our program, that's what's really interesting to us in terms of the impact that could have on the Fed's mandate to keep prices cooler. So what is your anticipation of the degree to which this could fuel price hikes?
Well, I think our call has been that over time, this has the likelihood of reducing the friction costs involved in buying and selling a house. And, economic theory suggests that if you take down friction costs, that should spur more liquidity, more transaction activity. So I do ultimately think that this is a net positive for transaction activity in the housing market. But to go as far as to say is that's going to have a meaningful impact as it relates to the Fed's inflation mandate over the near term, I don't think that is going to be all that impactful. This is more of a longer term, at the margin type of impact.
Ryan, are we already seeing the impact from this, just in terms of the fact that the industry might be self-imposing some of these rules ahead of tomorrow? And to what degree have we seen maybe some pressure on the decline, maybe in the buyer agent commissions?
Yeah, it's an interesting question. There's different data points that other companies have highlighted in the brokerage industry that does show some modest downward compression on buyer agent fees over the last few months. I think it's too early to tell whether or not that's actually meaningful and whether or not that is a result of these changes, because keep in mind, the changes really aren't even going into effect until tomorrow. There's been some geographies that have implemented them over the last few weeks. So I think we're going to have to see how that data looks over the coming months. But thus far, I think, there's been a lot of chatter amongst the agent community, more and more education on the part of consumers. And so the question becomes if belief creates reality, around commissions actually coming down. If both agents think that commissions are coming down and consumers are aware of this new structure, we do think that puts downward pressure on commissions at the margin over time. Thus far, I think too early to tell.
Ryan, for investors out there trying to figure out what this means for a name like Zillow, what it means for a name like Rivan, how much pressure, is it going to put further pressure on those stocks, or has much of that already been priced in at this point?
Thus far, it's caused a lot of headline risk and volatility in these stocks as the different headlines have come down over the last year. You've seen, the brokerage stocks and companies like Zillow that have more exposure to the buy side commission, see negative reaction to these headlines. As these changes actually play out, I think you're going to continue to see headline risk and volatility. Over the long run, what we've said is that this is actually an opportunity for the players that have scale in the brokerage industry to capitalize on this change, potentially grab more market share as this potentially washes out some of the more marginal agents across the country. And for the real estate portals, companies like Zillow, obviously, there's been a lot of efforts to evolve the overall business model. We do think that the role of the real estate portal companies like Zillow, CoStar's, Homes.com becomes more prominent in the wake of these changes. But near term, for any company that has exposure to buy side commissions, I do think this is going to continue to create volatility in those stocks.
Ryan, in our final 30 seconds with you, I want to unpack the housing starts data that we got in this morning, indicating that there is a little bit more pressure than potentially priced in when it comes to activity in the housing market. What is your take on whether or not that is sending us a more bearish signal about the broader activity that we're seeing in the housing market, or is that maybe some idiosyncratic information that just showed up in today's data?
I mean, we try not to read too much into the month-to-month data around starts and data points like new home sales, but I think overall, the overhang of supply is probably one of the biggest dynamics impacting the affordability issue in the housing market. More recently, this meaningful decline that we've seen in mortgage rates over the last few weeks, I think it's probably a bit more incremental in terms of what the go-forward outlook is for housing in terms of helping that affordability issue and potentially spurring more starts, more activity to help take care of that supply dynamic. So it's going to be interesting to see as we head into the fall and winter months, which are typically seasonally weaker months, how much this reduction in rates ends up spurring more activity to counteract some of that otherwise negative seasonality.
All right, Ryan, thanks so much for joining us this morning on this news. We really appreciate it. Ryan Tomasello, KBW's Managing Director. Vice President Harris is set to outline her economic agenda in her first set of public policy proposals since announcing her campaign for president. The plan will include up to $25,000 in down payment support for first-time buyers and a child tax credit, as well as a push against so-called price gouging. For more on these proposals and the potential economic implications, we've got Paul Krugman, New York Times opinion columnist and Nobel Prize winner in economics. Paul, it's great to have you on. So I want to start on the price gouging. I'm sure you've been on Twitter this morning and you've seen finance community having a field day, rolling their eyes at price gouging proposals. So I want to get your take. Is there a route where telling businesses, hey, we are looking at prices can be effective, or is it the traditional market view that prices are always going to be whatever the consumer will bear?
Oh, I mean, price gouging happens. It's not, if you think that there's never an issue there, then you're stuck, in chapter 3 of your economics textbook. There have been real episodes of price gouging in the past. I think a lot about what happened in California in the electricity market in 2001. So it's a possible issue. And now, if the Harris people think that price gouging was a central factor in recent inflation, I'd be worried because I don't know very many economists who think that that's right. If they think that it's okay to single out a few examples and make some gestures, fine. So, a lot depends upon what you think this is telling you. Not that it's not bad economics to worry about companies exercising market power. It is bad economics to think that you can put aside all of the normal macroeconomic issues. And my guess is that this is mostly, this is an extremely popular position, and they're making a gesture, and they might single out a few examples, but probably not more than that.
Paul, what about, though, the ability to implement it? How big of a change, how big of an impact it's going to have? What does that more realistically look like? And then as we take a step back and try to figure out where we are in this fight to tame inflation, how much progress has been made, what is your assessment just about what the road ahead looks like?
Well, basically, we are, we've beaten inflation. I mean, once you take out sort of lagged effects of housing, most measures are pretty much at the Fed's 2% target, or at most, a fraction of a percentage point above it. So that's it. I mean, it's it's kind of odd to be going after. Well, all right, but the point is that fundamentally we've made a full round trip on inflation. We are back to a reasonable level, a level where people looking forward. And I look at the expectation surveys, people's expectations of inflation are now low enough that we've entered that space where people just don't think about inflation much in making their decisions, which is where you want to be. So that's a war that's been won. And all of this that's not really the concern now.
What is the concern then?
Well, I'm worried, it's extremely fuzzy and foggy. But it does look as if we are starting to see that that long period of very high interest rates is starting to take a toll. And at this point, you can pick your economic measure and be either optimistic or pessimistic, depending upon your personality. But it does look as if there's at least some risk that we might be tipping into a slowdown. We're almost certainly not in a recession now. We won't be in one for a few months, even on the worst case scenario. But it's time, time for the Fed to start cutting, time to signal that we understand that the job is done, and now priority one should be making sure that this is actually a soft landing and not crashing into the runway.
Paul, I really appreciate you saying that, because sometimes while we're covering this, I feel like I could just pick any data set to tell any narrative. I'm not sure which one to pick. So I appreciate your explanation on that. But it makes me wonder how big a risk you think any potential slowdown might be, particularly for the Harris campaign as we do head towards November.
Well, if there's going to be a noticeable slowdown, it's going to have to happen quite soon for it to have a big impact on the campaign. I mean, it takes people's views of the economy will, for the most part, be shaped in the next month or two. Data coming in on November 1st are not going to move the election unless there's a financial crash. So the 2008 election was probably determined by the collapse of Lehman Brothers on September 15th, but that's there's no sign of anything like that on the horizon. So unless there's a big spike in unemployment, I would almost say that the next jobs report is going to be the last one that matters for the election. And right now, it's so far as objective economic indicators go, it's a pretty good place for Harris. It doesn't look, it's very unlikely that we'll be in something that looks like a recession in time for it to matter to voters.
And Paul, I'm interested in getting your take, too, on some of the reaction we've seen from Silicon Valley as we head into this election, particularly thinking about some of the tech billionaires, Elon Musk amongst them, supporting former President Trump. What do you make of that motivation, given Trump's broader base of voters?
Well, I mean, tech billionaires are those particular rich are not like you and me. They have their it's not even, I think, financial self-interest. There are ego issues. There's this sense that maybe they aren't respected enough by liberals, something like that. And remember, these are the crowd that has rallied around Trump in Silicon Valley are heavy overlap with the people who a year ago decided that RFK Jr. was their great shining hope, which just goes to show that they have extremely bad political judgment and are kind of, they've somehow convinced themselves that Trump is their guy, even though realistically he's probably bad for their financial self-interest.
Paul, as we wrap this up, I want to ask you about the recent commentary that we got from former President Donald Trump there. In his comments on an independent Fed, he obviously wants a little bit more sway. It's likely not going to be an independent Fed as an issue, likely probably won't sway voters or the outcome of the election. But talk to us just about the importance of it and maybe why voters should care a little bit more about the independence of a Fed and the implications then for the economy.
Yeah, I mean, we had this little bout of inflation, but by and large, for the past 40 years now, we've had stable, low inflation. And the way we did that, we and other rich countries did that, is by having independent central banks. There's nothing in the Constitution that says that the Fed is independent. There's nothing to stop Congress from passing a law tomorrow that says that the Fed becomes a part of the executive branch and runs at the discretion of the president. But we found that as a practical solution, leaving monetary policy in the hands of quasi-independent technocrats is a pretty good system. They don't always get it right, but better than having it be at the whims of politicians. Now, that's a big issue. And I don't, if Trump is elected, to think that he would stop at having a say in the affairs of the Fed would be completely at odds with everything else. He would want to run the Fed. He would want to say that monetary policy operates in the service of my political agenda. And that's a path that has gone very badly. I mean, you don't even have to go to Venezuela or something. The last time we had really serious politicization of monetary policy was under Richard Nixon. And the results were disastrous. It was a gratuitous burst of inflation that helped to set the stage for everything that went wrong in the rest of the 1970s. So, voters, I would be curious to have a poll to find out how many voters even know what the Federal Reserve is. But for business people, this should be a big deal.
Really good point, Paul. And thank you so much for making the time to join us. It's always a pleasure to have you. Thank you. Paul Krugman, New York Times opinion columnist and Nobel Prize winner. Thank you. Well, coming up, spa mode, but for your car. Ford says its new Lincoln is made for spa lovers and gamers. What a combo. We'll tell you exactly what that means on the other side.
A group of bipartisan lawmakers have sent a letter to Meta CEO Mark Zuckerberg expressing concern about the sale of illegal drugs on the company's various platforms. Now, this follows a Wall Street Journal report alleging that ads for those drugs appeared across Facebook and Instagram. For more, Yahoo Finance's very own Akiko Fujita is tracking the story for us. Akiko.
Hi there, Shauna. Yeah, that letter from lawmakers specifically cites that Wall Street Journal article that alleges Meta continues to collect revenue from hundreds of ads selling cocaine, opioids, and other drugs. The bipartisan group saying specifically that Meta appears to have continued to shirk its social responsibility and defy its own community guidelines. Protecting users online, especially children and teenagers, is one of our top priorities. We are continuously concerned that Meta is not up to the task, and this dereliction of duty needs to be addressed. Now, this all, of course, stems from that Wall Street Journal article, and the company's already under federal investigation for its role in the illicit sale of drugs and ads promoting its use would be direct violation of the company's own ad policies that ban the promotion of illegal drug use. The Wall Street Journal's reporting shows that dozens of ads marketing illegal substances continues to run on both Facebook and Instagram, and those ads steered users to an online marketplace for illegal drugs. The Journal reporting that some of those ads showed prescription drug bottles or bricks of cocaine, saying, "Place your orders." Now, in this new letter, lawmakers don't just accuse Meta of failing to stop those images, but making money off of them, saying this wasn't user-generated content on the dark web, but advertisements approved and monetized by Meta. Now, Meta has previously said the company is working closely with law enforcement to combat the activity. They also have AI tools in place to moderate content, although the Journal's reporting does suggest that those tools haven't been able to detect those ads. Now the lawmakers are demanding specific details from the company. Number one, how many ads the company's discovered promoting the illicit use of illegal drugs. Number two, how much revenue Meta has collected from those ads. And finally, what action the company is taking against those who are placing the ads. And we should note, guys, the Wall Street Journal's reporting has also featured at least one family that lost their 15-year-old son to a drug overdose. Their reporting suggests that messaging points to the fact that this person was able to contact the person who supplied drugs through DM on Instagram as well. So this isn't just about those ads, but also what the Wall Street Journal's reporting suggests are lives lost as a result of them.
All right, Akiko, great reporting as always. Thank you so much for joining us on that important story. We appreciate it. Well, now we're taking a look at some other trending stories on Yahoo Finance, and we're going to do it in 30 seconds each. So let's get that clock going. First up here, we've got Rocket Lab. It's heading to Mars. Shares of the space company surging on the news. Rocket Lab, in partnership with NASA, sent 2 spacecraft to Cape Canaveral, Florida, to get ready for launch to Mars. Now, Rocket Lab doesn't exactly have that date for liftoff just yet, but if all goes well, the mission is set to measure plasma and magnetic fields around Mars in an effort to help scientists understand the climate. And what's important to note here from my perspective is that there is a $55 million price cap on this mission. That is a tenth of the broader goal that we saw from NASA of $550 million for the Simple X mission. So it's definitely seen as a potential move towards keeping these trips to space a little bit more affordable, Shauna, and you can see the stock certainly up after that.
Yeah, exactly. And the company's CEO saying that after a meticulous and speedy build and test phase, we're excited to have the blue and gold on their way to the Cape and a step closer to Mars. Well, let's switch gears here and talk about a brand new vehicle that might excite some of you, a spa experience in your car. It sounds too good to be true, doesn't it? Ford revamping its Lincoln Navigator. The new 2025 model is going to include a spa and gaming features. And what Lincoln is calling sanctuary mode, your car is going to change its climate and releases scents, plays relaxing videos and sounds. It sounds amazing. Pricing, though, for this vehicle, it's going to cost you, it's just under $100,000. And maybe to paint an even clearer picture for you, the driver's seat automatically slides backwards. This is, of course, when you are in park. It warms slightly and it makes massaging motions. I'm all in.
I mean, it's the next best thing to full self-driving. I love it. Moving on to another story, sad news for the Burner Bros out there. The Burning Man Festival, kicking off later this month, has not sold out for the first time since 2011. That is ahead of this event. 70,000 some attendees are expected to arrive in the Nevada desert August 25th. But potentially because of the weight of inflation, climate change, there may be a bit fewer faces there this year. And Shauna, it's really interesting because I know we're kind of laughing about it, but it is, potentially an example of economic pressures and people responding to that. Coachella also struggled to sell out this year. So the latest big event, I know that you and I were going to go. So it's really unfortunate.
Yeah, and also you mentioned climate change and climate impact too. Remember, it was sweltering heat a couple of years ago, 2 years ago. Last year, you had the torrential rains that stranded some people too. So there might be some that are also just hesitant to go, just given the fact that they can't rely so much on the weather. All right, keep it right here on Yahoo Finance. That does it for us for this week. But coming up next, you got Wealth. It's dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. We'll see you on Monday. Have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll discuss the best money moves you should consider ahead of the Fed's first rate cut. And it's never too early to think about your taxes. I'm going to bring you tax strategy advice straight from the source. H&R Block CEO Jeff Jones, he's joining at 11:15 a.m. Eastern Time. Plus, mortgage rates rising slightly this week, but we are at the lowest level in over a year. We'll talk about where rates need to go. Plus, we'll break down Vice President Kamala Harris's new proposal to help out first-time home buyers. We've got all that and much more during today's show. Let's get right to it. Stocks, little changed right now, ticking just slightly lower here. There you're taking a look at the Dow, the S&P 500, and the NASDAQ on your screen. Flat but fractional declines for the S&P 500 and the NASDAQ. But for the week, guess what? It's a different story. Put a smile on your face. The S&P and the NASDAQ on track for their best weekly performance since November. But, of course, that's a bounce back. To discuss what's next for markets and your investments, let's bring in Jeff Weaver, Allspring Global Investments Senior Portfolio Manager here. Jeff, good to have you here with us today. So let's put this move this week in context here, and ultimately for the buying on the dip mentality that has seemed to reemerge, where you're seeing investors kind of flow in right now.
Yeah, thank you, Brad. Thanks for having me. You know, my focus is on short-term bonds, and one of the things that has the market excited was this week's CPI report. The CPI report came in really as expected, up 0.2%. The headline CPI number down to 2.9%, and so this number is good for the Fed. It's good for the markets. It's good for the consumer. So, you know, I think with rate cuts on the horizon, I think that's, you know, the market is certainly embracing that. We still have a strong economy, though. Retail sales was higher than expected this week. Jobless claims were lower than expected. So, you know, there's been some concern about an increasing unemployment rate, but, you know, right now the markets continue to trade well, and interest rates are coming down at the margin, and that's what's driving a lot of flows.
And, you know, we had some commentary, some fresh commentary from Austin Goolsbee, the Fed, out earlier today, saying that he sees some leading indicators of recession flashing warning signs right now. How should investors read into that and adjust their portfolio strategy, if at all?
Well, I think that is the risk. The risk is that we are seeing the unemployment rate climb. It is at 4.3%. We were at 3.4% last year. So there is some concern that an increasing unemployment rate continues to increase, and that we, you know, potentially, you know, move into recession. That's the risk, and I think that's why Goolsbee and other members of the Fed are certainly preparing to cut rates at their September 18 FOMC meeting. They want to make sure that they move their what is now considered a rather restrictive monetary policy to be one that's much more neutral. So by decreasing rates, you know, they can help avoid that the risk of recession.
And certainly, and with that in mind, you know, as we get into that broader pathway, where would investors be apt to best really kind of consider how the Fed may move and the pace at which they will move in order to continue to modify their own portfolio in accordance and in anticipation with the Fed's policy pathway?
Right. Well, we do expect a 25 basis point rate cut on September 18th. We'll probably see a 25 basis point rate cut again in November and then again in December. So that is a slower path than what was expected perhaps earlier this week. Last week, there was a lot of anticipation of some pretty dramatic rate cuts, but really the numbers that we see are more balanced. We at Allspring Global Investments have been encouraging investors to extend duration of their fixed income holdings, have been encouraging folks to increase their equity allocations because there has been such a growth in cash. I mean, cash has been so attractive. Money market fund yields at 5% to 5.25%. It's a really nice place to be. But there is, the risk that as rates come down, the money market rates are so correlated with the Fed funds rate that those rates will come down, and that there are opportunities elsewhere. So we do encourage those that have excess liquidity or no liquidity needs, that they do put that money to work in the markets, and have been encouraging that. But nonetheless, cash rates are going to remain attractive. We saw $1 trillion come into money market funds last year. We've seen about $280 billion come in this year. So they're going to continue to remain attractive, and really have money market funds will continue to have a good place, a good place for your money as part of your diversified portfolio.
Jeff, just quickly here, when you're saying expand the duration of your fixed income, are you saying, look at longer time horizons for some of your investment vehicles that are leaning towards government or even corporate bonds?
Yes, that is the case. In our money market funds and our short duration strategies, we've been extending duration. This benefits your portfolio as rates come down. And we do think you don't have to go very far out the curve to benefit from rate decreases. Even going out just to 1 or 2 or 3 years, as rates come down and the curve normalizes, we would expect those securities to perform well.
Jeff, thanks so much for taking the time here with us today. Kicking off today's show, Jeff Weaver, Allspring Global Investments Senior Portfolio Manager. Jeff, good to see you.
Fantastic. Thank you very much.
You got it. Well, the consumer might be okay after all. Consumer sentiment data out today, rising for the first time in 5 months. And this is just the latest data point. Retail sales data, earnings reports, other commentary all suggest that people are still mostly spending. To break down what we've seen, market domination anchor Julie Hyman is here. Hey, Julie.
Hi there, Brad. Indeed, we got the University of Michigan consumer confidence reading this morning. That did tick up. And so that was another encouraging data point, because there was a lot of pessimism, right? We saw, and this is the monthly U.S. retail sales data, we had seen a couple of declining months here. And so when you look at the expectations, well, I'm not circling, but you see what I'm indicating here, that a couple of declining months that we had seen. We heard the likes of Home Depot out with some negative news and sentiment. Even Amazon was sort of indicating that consumer spending was perhaps a little shaky. But then yesterday kind of bolstered some of those folks' spirits, because we did see that 1% gain in July retail sales that was reported. A lot of that accounted for by automobile sales and gasoline stations. But even if you back those out, we're looking at a pretty broad-based gain across sectors. Now, we talked yesterday on market domination to Michelle Meyer. She's chief economist at the MasterCard Economics Institute, and she talked about kind of the process that we're seeing happen with consumer spending right now.
Where we're settling now is one which hopefully will feel a little bit more balanced, a bit more normal, a new normal, but maybe a little bit more normal and stable, where you don't necessarily have as large of a swings across the different sectors.
So basically what she's referring to is during the pandemic, we really saw kind of spotty areas that were gaining a lot of traction. People buying things for their home during the pandemic, seeing shortages though, so that affected things. Or buying, say, workout apparel, sneakers, because they were running, because they didn't have a lot of other outlets. And then all of the big swings that we have seen in spending going up on travel, but down on goods. So what she's talking about is now more of a normalization, where you're seeing more stable spending sort of across different sectors. Of course, another place that we saw this in evidence was in Walmart numbers, which also came out yesterday. I saw a little bit of a rebound in the U.S. comparable sales, although they have been relatively steady here. There's been a little bit of a talk of trade down effect to Walmart from wealthier consumers. And even if that is happening, again here, stability, consistency was sort of the message that Walmart came out with. And the CFO, John David Rainey, said as much in his interview with Yahoo Finance.
We've seen consistency with the consumer. If you look at each month of the second quarter, they were all fairly consistent. There was no step down in July as some had expected. And that's generally our outlook for the year.
So in other words, it's not as though there is this huge, frothy spending here, or that there's a lot of excitement about consumer spending. It's rather that the worst case scenario is probably not being realized of consumer spending falling off a cliff. You probably also have a lot of differentiation, right, between different income consumers. And Simeon Siegel of BMO Capital Markets has recently written about how important execution is going to be among the retailers. We're going to hear from a lot more retailers in the next couple of weeks. And as he pointed out, it's not that people aren't spending, but if they are being choosier about where they're spending, it matters about execution on the part of the retailers. Are they providing the merchandise that people want? Is it in the store when people want it? Is it a good experience, whether it's online or in the store? So here are just a few examples of the companies we're going to hear from over the next week. Target out next Wednesday, going to be really interesting. Expectations there are not for it to have done as well as Walmart, but we'll be watching that closely. TJ Maxx and Macy's will give us an idea of what's happening more in the apparel sector. BJ's and Ross also. So we'll be watching all these numbers closely to give us a fuller picture of what's going on here, Brad.
Yeah, seemingly all of those retailers on screen got my money at some point or another last quarter. Julie, thanks so much. Excellent breakdown there. Julie Hyman, be sure to tune in to Market Domination. You can see more of Julie later on at 3 p.m. Eastern Time. She'll count you down to the market close and through it. Also, everyone, switching gears here, the personal data of around 3 billion people has reportedly been stolen in a hack, according to a complaint filed in court Thursday. Bloomberg Law was the first to report the filing. Now, if confirmed, this would be among the biggest breaches in terms of the number of individuals affected. Here with more, we've got Cassandra Coyer, who is a privacy reporter at Bloomberg Law. Cassandra, great to have you here on the show with us. You've been covering this and reporting on it. So just give us the scope of this and what exactly may have been compromised.
Yeah, so we're still waiting for clarifications on if that number is actually accurate. The company hasn't come out and provided any additional details. So what we know, or what I know, is from this complaint, and the cyber group actually is the one that came out and said, hey, we have all this data and we're going to post it online and we're going to sell it for, I think it was around $1 million or more. It's hard to know at this point exactly how this breach happened, when it happened, or the exact data that was contained. Usually in these types of incidents and in the type of complaints that we see, it's often credit card informations, names, addresses, Sometimes it can be, depending on the data that was collected in the first place by the company, biometrics. So that can be pictures, fingerprints. Here we know that Jericho Pictures is a background check company. So you can think about the types of data that usually are gathered to proceed with those background checks. So that's probably the kind of data that's going to be at play here and involved.
And what do we know about the organization National Public Data?
I don't know much about them other than they're used by a lot of companies to do background checks. I know that it scrapes a lot of information online as well. So it's not just collecting data directly from companies, but also scraping, meaning taking information that's already publicly available online and sort of gathering it all in this huge data set.
And with that in mind, I mean, what does the time frame look like for us to get more information on this, knowing that there have been lawsuits that are now getting ready to go forward as well?
So it really depends. We see in those complaints that it ultimately comes down to when the company officially publishes a notice of a breach. And in those notices, you usually get a little more information in terms of the scope of the breach, more exact date of when it might have happened, and the specific kind of information that was involved. Companies do have requirements for when they need to report those breaches to federal agencies like the FCC. Sometimes they can issue those notices really quickly. Sometimes I see complaints where the company hasn't sent a notice letter or any more information until months later. Given the fact that this is a pretty big breach, like you mentioned, I expect that we should find out more soon. But again, it really depends on when that company takes those steps to provide more information to the individuals that are affected.
How will, and I guess you were just about to get it at the end there, how will people know if they are affected?
So again, through those notice letters and notice of breaches, usually this is when the company will reach out to the consumers. You may have gotten one of these notices before. I know I certainly have. They either come in a letter in the mail that says, hey, we are informing you that your data may have been compromised or may have been involved in such and such breach. Sometimes it comes in an email. So I would say through those methods, sometimes the company also will post on its website sort of a very public and general statement about a breach that may have happened. So these are some of the ways that you may find out that your data was involved in a data breach.
All right, Bloomberg Law privacy reporter Cassandra Coyer, thank you so much for taking the time. Great reporting on this. We'll be continuing to track any developments around it. And I hope I don't get that email.
You might.
Oh, no. All right. Well, coming up, everyone, fresh off of their latest earnings, H&R Block CEO Jeff Jones joins us to reveal everything you need to know about their latest tax offerings. H&R Block shares higher today after a better than expected quarterly earnings report highlighted by their artificial intelligence tax assist resulting in higher new clients conversions. For more, let's welcome in Jeff Jones, who is H&R Block's CEO. Jeff, good to see you once again here, and thanks for hopping on the program with us. First and foremost, as I'm taking a look through some of these earnings results here, largely beat some of the expectations here, revenue beating the forecast. And revenue forecast, rather, I should say, for 2025, beating some of the estimates and expectations here. Walk us into what you're seeing right now in the market and the demand for people getting help with preparing their taxes.
Well, good morning. And we're really happy with fiscal 24, which we just announced yesterday. I think it's important to remember what we've been up to strategically as a company. Obviously, we're known for consumer tax preparation, but the way we've been able to diversify into small business tax, small business services, our acquisition of the company Wave, which is a SaaS provider of small business services, our mobile banking platform Spruce. So when I look back across the fiscal year, we saw really nice growth in all of those different businesses. That's really what's contributing to the great performance in the year. But then also looking to 25, we have a really nice outlook for the year, and we see growth and potential really across the board in those businesses.
I mean, there's historically always been this human element at H&R Block, but you're seeing some success, early success right now with the AI tax assist as well. I mean, how far are we away from people just walking into an H&R Block location and just walking up to an AI assist kiosk and having things done that way?
Yeah, well, we're definitely leaning into artificial intelligence and specifically generative AI. AI tax assist, as you're talking about, we were really early to the market this past year, embedding this option for consumers to get help. And we're not forcing people down a certain path. This was a choice they could make. And we saw when new clients made that choice, they converted in our DIY software at a higher rate. That's really good news. To your point, though, our brand is grounded in human help, and we think the combination of artificial intelligence to help the consumer and artificial intelligence to help our tax professionals is really where we're headed. It's obviously very early for everybody, but we're embracing the potential of what this can do for our business.
So is that leading you to think that there might be any restructuring, any changes to that overall H&R Block experience, given the consumer demand and what type of tools they're gravitating towards?
We love to offer the consumer choice, and that's really what we're doing. If someone wants to walk into a location and have a 100% physical experience with a seasoned expert, you can do that at Block. You can work with that same expert fully virtually and never go to an office. You can do taxes on your own with our software. And increasingly, artificial intelligence will enable all of those experiences to be better. But we really believe that we're in a position to offer the consumer a range of great choices, whatever's best for them.
Jeff, what would you say are three things that all taxpayers should know before they file next year?
Brad, I get asked about tax tips all the time. And what I always tell people is, the tax return in your tax life is really like your financial fingerprint. And so it's a little dangerous to give very broad tips to the masses. But when I'm talking to our customers, what we're trying to do the most is get them the biggest refund as fast as possible. We're trying to give them confidence. We're trying to remove the surprise. And so some of the tips I give our customers are things like, as your year is going on, we offer a free check-in mid-year to get a sense of how your tax life is changing. So when it comes tax time, you're not surprised. Take advantage of that. People have life changes during the year, move, child, marriage, etc. And all of those things can change the outcome of your taxes. So think strategically about your withholding, and you really can be in control of your outcome a lot more than, maybe a lot of people believe.
Jeff, while we have you here, both President Trump and Vice President Harris, former President Trump, I should say, and Vice President Harris, who are campaigning, they have no tax tips proposals as part of their economic proposals. Not going to ask you to weigh in on the election, but how do you see a proposal or President Trump's proposal to get rid of Social Security taxes affecting H&R Block's business?
Well, thank you for not asking me to commentate on the actual candidates. mean, we're obviously in the tax prep business, not in the tax policy business. And so every single year, there are dozens, hundreds of changes at the state, local, and federal level. And what we do best is translate those changes into great advice for customers. So we always wait to see where policy changes actually land. You know, on the campaign trail, there are a lot of promises that may or may not actually become tax policy. But that's where we really focused is what are the changes they make and how do we help the customer gain confidence to execute against those changes?
Jeff Jones, who's the H&R Block CEO. Jeff, that's all we have time for today. We'd love to continue the conversation, though, in the future. Appreciate it.
Thanks, Brad.
Certainly.
Good to see you.
Likewise. Housing starts, they've hit a 4-year low in July as builders continue to feel the pressure of high rates. This morning, Vice President Kamala Harris revealed big plans for the housing market that she would tackle in her first 100 days if elected president. Here with the breakdown, we've got our very own Danny Romero. Hey, Danny.
Brad, the race to win your vote has started. Vice President Kamala Harris has revealed as part of her campaign that she wants to help first-time homebuyers. She's proposing to provide up to $25,000 in a down payment. So who would be eligible for this program? Potential homebuyers that have a 2-year history of paying rent on time. Now, this program is an expansion to President Joe Biden's program that proposed a $10,000 tax credit for first-time homebuyers. Now, Harris is expected to discuss about this housing proposal at a political rally today in North Carolina. But that's not all. Harris is also looking to fuel the construction of 3 million new housing units through tax incentives. But bottom line, the ability to address housing affordability has been a problem, especially for the White House. The housing market has been dealing with elevated rates and limited housing supply. So even though investors are expecting the Federal Reserve to cut rates next month, borrowing costs are expected to stay elevated this year. Brad.
All right, Danny, thanks so much. We know you're going to be listening in to see what the Vice President has to say on housing here. Well, mortgage rates ticked higher this week, but they are still below 6.5% according to Freddie Mac. Rates have been on this downward trajectory for a little over a month now. So what does this mean for the housing market? Joining me now, we've got Melissa Cohn, who is the Regional Vice President over at William Raveis Mortgage. Always a pleasure to get a check-in with you, Melissa. We've had some of these conversations over the course of the summer, and we've continued to see some slippage in the mortgage rate. That's a good thing for some potential buyers who are waiting to come off the sidelines here. But what do you think that level needs to get down to really see people come off the bench in droves?
I mean, if we want to see, the floodgates open, I would say that the rate has to go down to 5.5%. But the fact that we're down to 6.5% or just below that, well, if you think about it, we were not too long ago hovering in the mid sevens. I think that every 0.25% cut in interest rates will sort of bring that next level or next group of buyers back into the marketplace. And also, as rates drop, we will see sellers who've been locked into their low interest rates, consider selling their property and getting back into the market as well. And that would help us because we really do need more inventory.
What is the key thing that potential home buyers should be listening for in the next FOMC meeting, and even as we're set to get the minutes that come out from the previous meeting?
I think it's going to be, their tone. Are they making this rate cut because of the July jobs report, or, do they continue to start a cycle of rate cuts and that will be ongoing for a period of time? We've seen economic data that has clearly supported the fact that the rate of inflation is absolutely moderating down towards the Fed's 2% goal. But we've also seen, we had that really weak jobs report, but we also had a really strong retail sales report yesterday. So, it's really going to be, what is the strength of the economy and how far does the Fed have to go? And how does the bond market react to it? Because it's really not about what the Fed does. It's how the bond market reacts to it. Mortgage rates are tied to the 10-year Treasury. They're not tied directly to the Fed funds rate.
What happens if you see people both coming off the sidelines and then refinancing at the same time? What does that do to the broader housing market, if there is any kind of net impact that could be anticipated?
Well, I mean, obviously, if people are refinancing, that means that they're not selling, and that's not going to be adding to the inventory. I mean, rates are down, and I think there's been a tremendous amount of pent-up demand for people who have wanted to refinance, either to consolidate a higher rate home equity loan, to pay off credit card debt for home improvement. So, there are more people coming back into the refinancing marketplace, but, there are also a lot of people that will find that, when rates are lower, that modifying the mortgage is not going to give them the home that they want, and that they will in the end up trying to sell and moving on and adding more inventory to us.
And as we were just discussing with our own housing economy and housing market reporter, Danny Romero, the credit that the Harris-Walz campaign is looking to discuss later on today, if they take office and if they are able to kind of move that through Congress, what would that credit do for first-time home buyers from your assessment?
Oh, I think it's a wonderful thing that any grant programs that people can get in order to help them, with down payments or with closing costs, and especially with the new NAR ruling, if they potentially would have to pay the buyer's broker's commissions as well. Whatever we can do in order to get people into homes is the right thing to do. And I think it's a wonderful idea.
Melissa Cohen, who is the William Ravis Mortgage Regional Vice President. Melissa, great to check in with you.
Thanks so much.
Appreciate it. Much more on wealth after the break. You're watching Yahoo Finance. We're about 80 days away from the general election, and we're digging into the finances of everyone, including the vice presidential candidates. Yahoo Finance has an article up diving into Tim Walz's quote, uncommonly common finances, written by our very own Carrie Hannon. And the top line is, Walz doesn't own a single stock. He doesn't own mutual funds, bonds, private equities, or other securities. Carrie Hannon joins me now with more. Carrie, Walz doesn't have any of those assets I mentioned. So What exactly is present and what's the net worth? Where does it come from?
Yeah, oh, Brad, I mean, it's so interesting because it's pretty shocking in this day of the political figures we have out and about with the high net worth. He doesn't. He really is fairly common. His net worth is estimated to be between 112,000 and 300,000. And that's per his 2019 disclosure. So this isn't precise, but it's close to where he probably is. And then his current salary is around $127,000 annually. Now, the median household income per Census Bureau is around $74,580 in 2022. So he's higher than the average American, but by no means in this high earner category. So you can relate to these numbers in a way. Now, what he does have, Brad, is that from his years as a public school teacher, as a National Guardsman, as a member of Congress, and as a governor, he's got what we call traditional pensions, which not many of us have these days. And it comes to around possibly $800,000. Now, this is a number that the Wall Street Journal pulled up for their analysis. So I'm referring to what they have dug up, but it's a pretty good number, I believe. But again, this isn't super wealthy. It sounds like a big number, but what that breaks down to is around, $5,000 a month in retirement, or roughly $60,000 a year. So again, we're looking at pretty basic kinds of financial structure that the candidate has.
All right, Carrie, you're sticking around with us. We're joined now by Christine Benz, who is the Director of Personal Finance and Retirement Planning over at Morningstar. Christine is also the author of How to Retire, 20 Lessons for a Happy, Successful, and Wealthy Retirement. Christine, great to have you here with us. I want to get your reaction as well. You just heard our own Carrie Hannon lay it out as to Walt's financial picture there. What is your assessment?
Well, Carrie's absolutely right that Tim Walz is one of a shrinking share of our population who is covered by a pension at work. I think roughly 20% of workers have pensions. And the really nice thing about government provided pensions is that they do provide an inflation adjustment to help you stay whole with the cost of living increases. Private sector pensions typically do not have that, and so they're less valuable. But I think what's interesting is what Tim Walz doesn't have, which it doesn't appear that he has a lot of stock and bond assets. That's increasingly uncommon to see someone with his income level not have a portfolio side by side with his pension. And typically workers, even those who do have pensions, have the ability to invest in something, a 401k, 403b, and they should avail themselves of those opportunities because you have the opportunity for long-term compounding. The earlier you get started, the better.
So, Christine, what is he missing here in terms of not having equities and other investments in his portfolio? I understand that he has pension managers running some of that on the side that he has no control over. But from your take, what's he missing here?
Well, one obvious category would be having some tax-deferred compounding, which you can get in the context of a company or a government-provided retirement plan. And that's a beautiful thing to be able to invest and see your money grow, but not owe any taxes on it from a year-to-year basis. It's not possible to see whether he has holdings in the thrift savings plan, which is something that government workers are able to avail themselves of. The TSP, the thrift savings plan, is a gold-plated retirement savings vehicle. Anyone who has an opportunity to save within it should probably take advantage of it because you do have that opportunity for long-term growth. And you also, if you have a separate silo of assets, even if you're covered by a pension, that allows you to do other things with that money. So you could cover long-term care if you should have a need arise, or you could, put a down payment on a home, or whatever the case might be. You have more flexibility, certainly, than you have with that pension income.
So, Christine, one other sort of sidelight here. He actually doesn't own a home. He sold his home a number of years ago. How big is that a part of someone's retirement plan, having home equity?
Well, oftentimes it is people's biggest source of net worth. And as people age, having that home ownership provides a really great hedge against inflation. We've seen housing costs really go up over the past couple of years. People who own their homes, and older adults tend to own their homes at fairly high percentages, have effectively a hedge against those rising housing costs. So it's, I would say, a pretty rare oversight for someone of his level of wealth. I can understand why he might not, but it is a valuable asset and the biggest component of older adults' net worth. That is another thing that can be a huge advantage if someone does have a long-term care need, if they say need to move into a facility to get a higher level of care. The home can be a tremendous asset in that context.
And Christine, just lastly, from what you've evaluated, what about J.D. Vance? What is the financial assessment of the Republican vice presidential nominee?
It's a much larger portfolio, and I think it's also reflective of a generational divide. J.D. Vance is someone who has had a career in the private sector. His investments reflect that. It appears to be a pretty broadly diversified portfolio, lots of individual stocks, as well as a cryptocurrency position and some fixed income positions, but a better diversified portfolio. It's what I would expect of someone with a higher level of wealth. So I don't think a lot of surprises, though I will say that many investors, even those with significant levels of wealth, do use exchange traded funds instead of baskets of individual companies. But it does appear that J.D. Waltz has some private companies which are not generally investable in the context of a mutual fund or an exchange traded fund.
Interesting. All right. Christine Benz, Director of Personal Finance and Retirement Planning over at Morningstar. And thanks to our very own Carrie Hannon. You can check out Carrie's story up on yahoofinance.com. Thanks so much.
Thanks, Brett.
Well, Vice President Kamala Harris's campaign outlining some big plans for housing, and it includes construction of 3 million new homes over the next 4 years and tax incentives for builders who construct starter homes. And this comes while high interest rates and low inventory delaying a lot of folks' home owning dreams. But you can get into your new home now. To discuss how you can meet your new home ownership goals, we have Brandon Copeland, who's the Your Money Playbook author and former NFL player, here with us on set. Brandon, great to have you back in studio with us.
Great to be here. I appreciate you having me.
I mean, we've talked a lot about housing here today, especially with some of the demands in the market right now, plus the mortgage rates that we've seen move lower, a little bit more favorable at this juncture versus a month ago. Yep. And then on top of that, we're expecting to hear even more from political candidates, namely Vice President Harris today, about what some of those future incentives could look like. How is this all going to help home ownership become a reality for people?
Yeah, I think that one of the largest fears, especially for young people nowadays, is like, hey, how can I ever actually afford to buy the home of my dreams, right? And ultimately, I mean, obviously right now, every politician is being a politician and talking about what they want to do. So obviously the proof is in who is actually going to execute on some of the promises that they're making. But the goal will be to make this thing much more accessible for homeowners to be able to get credits, potentially tax credits, also have different grants that they can use to help them get into the home of their dreams.
Certainly. With regard to how even the basic regions that people are moving into, what's more coveted. We were recently looking at as well a journal article today based on some Redfin data, I believe it was, where there are more $1 million homes than ever before out there. I mean, what does that tell you about just the difficulty for people who are trying to break into home ownership and be able to amass their own equity and amass their own wealth that way too?
Yeah, well, one of the things we talk about in Your Money Playbook is sitting down and taking the time to map out your why and map out what your life looks like a year from now, 5 years from now. I just recently spoke to a group of students at VCU, and it was a group of athletes, and they sat down and did the exercise, and what they started talking about was, do I need to go chase living this type of lifestyle in this type of city versus can I find me a more affordable city to live in where I actually can have all of the things I ever wanted and more, and have a better potential quality of life. Unfortunately, a lot of times now when you are making the decision to purchase that home of your dreams in that neighborhood that you always dreamed of growing up in or living in, you also are subjecting yourselves to potentially being on a hamster wheel the rest of your life, because now you are purchasing a bill to live in you're purchasing a lifetime bill and a lifetime of debt to live in a certain area when you may consider a different state, a different county, someplace that you never imagined you'd live in before. But if you take your family and go down there, you might be able to change the pressure to keep up with the mortgage that you are now signing your name over to.
You know, it's so interesting. And you mentioned going through that assessment and that assignment with athletes as well at VCU. Mm-hmm. I also think for athletes, and I actually love this post on X that I saw during the Olympics by an Olympian saying, you know, stop asking us what we're going to do next. Like, we just won a medal. I think it may have been Simone Biles that said it. Yeah. But anyway, all of those things considered, there is that thought for athletes of how to plan out for retirement, how to plan the financial future. How should athletes be planning for retirement as well? Yeah, absolutely. I think you have to be understanding that although in terms of your mindset, especially for me as an NFL player, I'll put it in my perspective. I had to tell my mind that I was a superhuman every single Sunday, to walk out through the white smoke, to hear 70,000 fans screaming praises or booing you, but to trick my mind into going and basically battling another 300-pound grown man and moving them out of the way. I had to tell myself I was superhuman and I couldn't lose and I couldn't lose and I couldn't lose. And then now what athletes are talking about is you get off the field and people tell you now you're human again and plan for when this thing does not work out. And that's real. And so what I would always suggest to athletes is understanding that although you're superhuman, you also know that this thing will end one day, and you are making a whole lot of money right now that most people would dream to be making. And so you need to protect it, and you need to save, and you need to invest and put as much money of that money to work for you as possible during your prime earning years, because that return will be what is your potential salary in future years. Absolutely. Brandon, great to see you. Great to have you back in studio with us. Brandon Copeland, Your Money Playbook author and former NFL player, joining us here on Yahoo Finance. Appreciate it. Appreciate you. Much more on wealth after the break, everyone. You're watching Yahoo Finance. The Inflation Reduction Act turns 2 years old today. President Biden signed it into law on this day, August 16th in 2022. And if you don't know, the law is focused on lowering inflation, addressing climate change, and adding jobs by funding domestic energy production, promoting manufacturing, and lowering drug prices. So, what has the Inflation Reduction Act achieved so far? Here with more is our very own Rochelle Akufo. Hey, Rochelle.
Hey, Brad, good to see you. So, as you mentioned, August 16th marks 2 years into this 10-year plan. So, a lot of these key provisions and investments in the Act are expected to happen through 2031. But what's happened so far? Let's start with healthcare provisions. For Medicare beneficiaries, negotiating lower prices for certain drugs, capping the cost of insulin at $35 a month, and extending the Affordable Care Act subsidies through 2025. Also recently announced a $2,000 cap on out-of-pocket spending, which will be fully in effect in 2025. That's expected to save 19 million beneficiaries an average of $400 a year. That's according to the White House. Let's also take a look at the climate provisions. We know that homeowners are benefiting from tax credits and rebates for energy-efficient home improvements. So one of the examples in the IRA, and 30% tax credit for installing solar panels and other renewable energy systems, including wind, geothermal, and battery storage. Plus also tax credits for buying new and used electric vehicles, $7,500 in tax credits for new EVs and up to $4,000 for used EVs, up to a value and income limit. And of course, all of this is to reduce reliance on fossil fuels and lower overall costs of care and home ownership. Now, there's also a tax credit of up to $40,000 for buying certain commercial EVs. So certainly some of these businesses can get in on the action here. And staying with companies, there are a range of tax credits for clean electricity production, investment and manufacturing production, as well as deductions for energy-efficient commercial buildings. Now, the White House expects this to create 1 million green jobs. Keep in mind that's over that 10-year period. And you can get full details and eligibility from the IRS and Energy Department website. So obviously it's a long-term plan that you're looking at here over 10 years. And of course, with the election coming up in November, a lot of those things can change depending on who wins and what gets rolled back, Brad.
Yeah, indeed, Rochelle. And no matter what, none of them are going to be in office for 10 years to see it all the way through. But we hope it has an impact for that long. Rochelle, we appreciate it. Thanks so much. Ever wanted to start your own business? We've got all the tips and tricks right after the break. Stick with us. Over 99% of businesses are small, according to the Small Business Administration, and 20% fail in the first 2 years of being open, according to the Bureau of Labor Statistics. But there are resources out there. It's not all doom and gloom. To break down what entrepreneurs need to know, here with us, we've got Darlene Goins, who is the Wells Fargo Head of Philanthropy and Community Impact. Darlene, great to have you here on the program with us. So first and foremost, I think people just need to know, and entrepreneurs just need to know, what is a community development financial institution that could help their business outlast some of the typical fail points?
Sure. So thanks for having me, Brad. A community development financial institution, or a CDFI, can often provide affordable access to capital for small businesses. So one of the things at Wells Fargo that we created was the Open for Business Fund. We took the processing fees that we received for administering the Paycheck Protection Program in 2020 and created a $420 million Open for Business Fund to provide flexible capital to these CDFIs as well as other community organizations to be able to support small businesses as they recovered and came out of the pandemic.
It's so interesting for small business owners and aspiring entrepreneurs right now. Many of them I see in real time because they go digital first in many cases, and they have that strategy, especially if they're a business to consumer type of business here. But all of these things considered, what are some of the top tips for small business owners and entrepreneurs right now?
Sure. So I would say definitely tap into the small business ecosystem of support. So there are lots of community organizations near you that offer grants and microloans and technical assistance, that real specialized advice that can help you think through how to help your business grow and thrive. Reach out to local business development centers, the Urban League, local universities to tap into that ecosystem of support. Secondly, I'd say seek out personalized technical expertise. So over half of the small businesses that were served by the Open for Business Fund, we served 336,000 small businesses. Over half of them that got technical assistance received it for free in a one-on-one format. And so CDFIs and other community organizations often provide that technical guidance to help you think through how can you qualify and apply for federal and state programs? How do you access affordable loans? How do you think about negotiating commercial leases? All types of technical expertise that you can use for your business.
Darlene.
And then I would say,
I'm sorry.
Sure.
Yes, one last quick.
Yes, Brad.
I'm sorry, we're pressed up against the 12 p.m. hour here, Darlene. We got to leave things there on the day. It's Darlene Goins, who is the Wells Fargo Head of Philanthropy and Community Impact. We got to have you back. We want to continue this conversation. Very valuable insights and tips for a lot of small business owners and entrepreneurs out there, Darlene.
Thanks, Brad.
Certainly. Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned. Market Domination comes up 3 p.m. Eastern Time. You don't want to miss it.